The golden age of America begins right now. Today, I will sign a series of historic executive orders. With these actions, we will begin the complete restoration of America and the revolution of common sense. I will declare a national emergency at our southern border. The inflation crisis was caused by massive overspending and escalating energy prices, and that is why today I will also declare a national energy emergency. My proudest legacy will be that of a peacemaker and unifier.
This is Bloomberg Surveillance, live from Davos, with Jonathan Farrow and Lisa Abramowitz.
Live from Davos, Switzerland, for our audience worldwide from the World Economic Forum. Good morning, and welcome to a golden age of volatility. Yesterday afternoon, people got excited, Lisa, about the prospect of the incoming president taking a measured approach with trade. Then he got into the Oval Office and changed things pretty quickly.
Yeah, and this really speaks to the fact that JP Morgan has a war room to look at all of the ins and outs of what proposals are coming out, to really understand what they are, what they could potentially be, and then change it all again the next day when there's some new proposal coming down the pike.
So bad news if you are Canada and Mexico. Maybe by February 1, maybe there might be some tariffs coming your way. Good news for Europe and China. I would say it's far too soon to say good news for Europe and China. Things can change very quickly, and we saw how that played out in the last 24 hours.
What we're seeing right now is we are here in Davos, Switzerland, with, I believe those are afternoon bells that are actually ringing right now, not morning bells.
I should say good afternoon.
I think that you need to adjust and adapt to the place where you are, and I think that right now we are good afternoon, good afternoon.
You want us to start the program again?
No, I think that this is good. But I think that going back to the whole idea, we start the show with the idea of Washington, D.C., and yet here we are in Davos, and that is all that everybody is talking about, and I think that that really highlights the degree of the golden age of volatility, as you put it. This is what people want to know about at a time when the U.S. is the dominant growth engine and the dominant force of change in the global market.
This is not the center of the universe this week, if it ever was. It certainly isn't this week. The center of the universe is Washington, D.C., and we've said this a few times on this program. The president will act and Davos will react, and that basically tees up the programming for the next 3 days.
And basically the reaction is, we're in, we believe in it, we're with you, Donald Trump. How can we get a piece of the dynamism in the United States? And that's what we feel around the board. The issue is, how much does this shift from some of the rhetoric that we've heard at this very meeting in the past number of years?
To your point, and to build on that, if you're in the United States right now, you feel pretty good. If you're outside trying to get in, you're probably pretty nervous and quite anxious, because there is a long, long line of companies that are looking to do exactly the same thing.
Which is the reason why there are so many bankers here who are talking to clients about just how to do that. Big question will be, who will be allowed to do that, how much the regulatory regime has changed, and just how many international companies are looking to become just a little bit more American.
We'll talk to one of those bankers in just a moment, so stay tuned. For now, though, we have to head down to Washington, D.C. and catch up with Anne-Marie in the nation's capital. Anne-Marie, what a day one. What's in store for day two?
Well, look, we're going to probably get a lot more executive orders. That is what Donald Trump promised, and that is what he delivered yesterday. If you guys have been talking about, it was a flood of executive orders. The priorities, really, though, were things on immigration and also energy, lifting that moratorium on LNG exports, so rescinding some of the Biden-era executive orders we saw, and also adding some of his own, pulling the United States, for instance, out of the World Health Organization. Also, when it came to TikTok, when that executive order hit his desk, he did say, ooh, TikTok, I like that one. Why? Because he feels like he's now in charge to potentially save, and he wants to maybe have a deal, give this social media app a little bit more time to strike a deal. What was so interesting, though, was not in an executive order. And, of course, that was explicitly aimed at other countries when it comes to tariffs. That was missing. But we did get a bit of back and forth with President Donald Trump in terms of where he's going with tariffs, and he's eyeing Mexico and Canada. Take a listen.
We're thinking in terms of 25% on Mexico and Canada, because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in, and fentanyl to come in.
When do you think you would enact those?
I think February 1st.
February 1st potentially is going to be the timeline when it comes to Canada and Mexico. Not only is this back and forth, the whipsawing of headlines might be a nuisance for financial markets. What was so interesting is a country that was not mentioned, China. At the moment, President Trump says he was invited to China and he's ready to make some calls and maybe a deal with Xi Jinping.
Anne-Marie, stay tuned and watch this space. I get the feeling we're going to be saying that a lot over the next 4 years. Anne-Marie joining us from Washington, D.C. this morning.
Yeah, basically we're talking about the whipsawing of the news flow that really will impact companies around the world. And they're trying to adapt right now, even as the headlines seem to change day to day.
Joining us now to discuss, I'm pleased to say that alongside us to kick off our coverage of the World Economic Forum, Vis Raghavan, the head of banking at Citi. Vis, it's good to see you, sir.
Good morning, or good day, as we should
Good
say.
afternoon, I think Lisa wants to go with. How improved is the mood in corporate America with a simple change at the top of the country?
Look, it was improved post-election anyway. So you saw the frenzy, you saw a lot of expectation, the build-up, the anticipation was you could feel it, and I think look, it's risk on. Folks want to go. There's a ton of liquidity out there. There's a lot of pent-up excitement. So let's kind of wait and see.
Which areas are you seeing the most excitement? Is it really foreign companies looking to get into the U.S.? Is it U.S. companies that were stymied because of the FTC under the Biden administration? Where are the areas of the pipeline that are building most quickly?
Look, it's all of the above. I mean, if you look at the valuations of U.S. companies, I mean, we talked about it a lot. You have pretty much 68% of the world's capitalization now in the United States, and that is just increasing by the day. And you're seeing the biggest pools of liquidity are all in the United States. So you had the building blocks of when we look at the valuation arbitrage, U.S. corporates versus even Europe and rest of the world. I mean, there's a massive differential. So and then you have a lot of liquidity. The PE community have $2.5 trillion or thereabouts of firepower, which they've been waiting to deploy. You have and private credit, you have pools of liquidity that is kind of available. So you've got all the building blocks, to kind of get this thing moving.
Yeah, go ahead.
Just one point on that, on your question. I would say it is U.S. companies have all the ammunition to go outside and within, and given the Make in America, the U.S. nexus, a lot of the overseas companies will look inwards into the U.S. to basically open plant, do CapEx and the like.
Well, that's exactly where I was going to go. You're a global head of banking for Citigroup, which is a global bank and has traditionally stretched its tentacles across the world. How many of your conversations are dominated by the United States right now?
I mean, U.S. is at the epicenter of all discussions. I mean, whether it is at a basic level, supply chains, working capital management, how do we get organized around, dollar flows and the like. You're seeing our corporate bank, our treasury services businesses absolutely kind of, engaged in dialogue around how to get organized. And that also translates into the boardroom. I mean, if you look at, with the valuations currently in the United States, with that comes responsibility, because companies and boards have to say, okay, for this valuation, I've got to show growth. It's either going to come organically or through acquisitions, because shareholders don't have patience. So the minute your growth is not forthcoming, they work with their feet. So guess what? I either have to grow organically or I have to go buy and build. So you then, once again, you have a strong dollar, which is in the U.S.'s favor. You have this valuation. So all the currency is there, the backdrop is there. So let's see.
What I hear from you, though, is not just U.S. companies, not just European companies trying to get into America, but U.S. companies using their very well-valued equity to look at Europe with an exchange rate on their side. How much of that can we expect in 2025? Are you already having those conversations actively with companies looking to pick off European firms?
The tailwinds are all the things I described. You have gems of companies, sometimes we call them good houses in bad neighborhoods. Dollar earners, but trapped in certain jurisdictions where there's a valuation, impairment, and U.S. companies are eyeing them. Private equity is eyeing those jewels. The key is going to be around the headwind is going to be, do nationalist tendencies kind of suddenly take hold? If the tariff regime gets kind of heated up. If barriers are erected, by the United States, so who retaliates? How do they retaliate? So suddenly now, if you have a cross-border visible transaction, and suddenly countries will say, these are jewels in my crown, not for sale, and then the barriers and the hurdles.
Let's take it one step further. I think a lot of people made quite a lot of the people who were at the president's inauguration, all the tech CEOs lined up. Some people were very cynical, skeptical about why they might be there. I take a very different view of what was taking place in the last 24 hours. That was a celebration of the best of America. the biggest leaders, not just in corporate America, but around the whole world. And we get the real sense now that the incoming president is going to look to protect them and look to go out to places like Europe and say, we've got their back, you stop going after them. Do you expect to see more of that, not just from the Americans, but also from the Europeans and maybe for the Chinese as well?
I do. But let's go back to your question on tech. Tech is not tech alone anymore. I mean, it is a common thread across every industry. If you take auto, it's autonomous driving. It is, if you take, healthcare, retail is e-tail. So even a old-fashioned, very industrial company, when they're looking to acquire, in software and all the kind of the tech adjacencies. So you're seeing tech permeate pretty much every industry right now, and and this is something even from a banking point of view, that mining of the seams is something that you need to do really, really well, because that's where most of the activity is going to be. In addition to all the pure tech like the whole AI space and the like, and cybersecurity. So all of that pure tech is going to thrive, but those tech adjacencies are also going to thrive. So I can almost kind of understand that roster on the front row is really the way, the direction of travel that we were already on, but that's going to get even more pronounced, as we see the administration and the future pan out.
It also speaks to, as John said, the golden era of volatility and wanting to have a foot in the door at a time when there is so much uncertainty and competing headlines. JP Morgan was talking about a war room, trying to understand each headline as it comes out, and they've been up all night. Is there something similar in Citi's banking department?
Most banks have, groups absolutely dedicated to really parsing through every line of what was said, what was not said, what the direction of travel is, and Citi is absolutely the forefront of, the internal thinking as well as kind of, advising clients on what to expect.
So you've been at Citigroup for now a full year, more than that.
7 months.
7 months. So 7 months, not even a full year, but completed the fiscal year, and it was a very good year. And I'm just wondering how much you attribute that to the business cycle and how much you attribute that to changes that you personally have made at the banking division.
I would attribute a lot of it to the changes Jane has made. I think she's really, grabbed the business, both from, the stuff that needed remediating and transforming, and also the focus on the front office, the client side, and absolutely kind of dealt with it kind of head on. And when you look around the teams, there's a vibrancy, there's really an entrepreneurial kind of, as we say, we wake up in the morning, there's a spring in our step that you're building something amazing and you're part of something amazing. And that's infectious, and you saw the results, both the quarter and the year, there's real momentum. So I would really kind of, give the credit to, Jane and the leadership team and all the building blocks they put in place that is really now allowing us to kind of, build off that and to take it to the next heights.
As you look around the room,
yeah,
a table full of very exceptional talent, there is one empty seat, the head of M&A. When does that get filled?
I mean, look, I think, that seat is when you look at the bench underneath, we have some outstanding talent underneath. Kevin, who runs the group, is an outstanding M&A practitioner and has been in the industry for a very, very long time. And within each of our industry teams, we have real M&A, outstanding professionals. So we got, the healthcare team is a team we hired from Goldman, and they were right at the forefront of the Johnson & Johnson trade we announced recently. Lilly, so there's a lot of momentum. There's a lot of deals up the pipe. So what I want to really do is kind of really measure a bit instead of just kind of rushing into things. There's a lot of talent, internally, and I just want to kind of take a call on, how the months pan out, what momentum we have, how we kind of, get established, and then address that.
Could you give us a sense of whether there are any active interviews taking place right now?
No comment.
No? So there might be externally, not just internally.
I would say everything, be open to all ideas, but there's such a deep bench there that, I just want to kind of evaluate what I have first.
I hear that from you. What I also hear is there is a real potential that the seat just doesn't get filled and you can accomplish some of your goals without a vacancy being filled.
Absolutely. I mean, that's what I'm saying. The bench strength is so strong. that, we're doing all the M&A deals, and if you look at our announced deals, if you look at our pipeline, there is a lot of progress, there's a lot of momentum. So I really want to just kind of digest what I have and then, take a call at the right time.
Sounds like you're ready to hit the ground running. A lot of people are in the United States right now. It's going to catch up.
No, it is. I mean, this is kind of there's a lot of excitement, there's a lot of anticipation, and all the building blocks are there to kind of make something out of it. So
the mood's improving in corporate America. Vis, it's good to see
corporate America. Let's emphasize that.
Yes. Well, I have been repeatedly. Don't worry. It's very different for everybody else. Vis, it's good to see you. Thank you.
Likewise. Thanks
Vis
for having
Raghavan
me.
there of Citi. Thank you, sir. Let's get you an update on stories elsewhere this morning. Let's head over to Danny Berger to get your Bloomberg brief. Hey, Danny.
Hey, John. Los Angeles is facing extreme fire risk for a third straight week as hurricane-strength winds return. A rare, particularly dangerous red flag warning has been raised across the region. Wind gusts as strong as 80 miles per hour are forecast. Ventura, Malibu, and San Fernando are among the cities most in danger. Veteran Republican Senator Marco Rubio has been confirmed as Donald Trump's Secretary of State. He's the first of President's second-term nominees to be approved. Rubio served 14 years on the Senate Foreign Relations Committee. He was cleared by a vote of 99-0 in the Senate. Meanwhile, in D.C., Elon Musk has secured a White House email address. The billionaire, who is set to lead the Department of Government Efficiency, also has an office space in the Eisenhower Executive Office building within the White House complex. President Trump said that DOGE will work with the White House to identify spending cuts and finish its recommendations by July 4th of 2026. And that's your Bloomberg Brief. John.
Danny, thank you. Up next on the program, the golden age for the U.S. economy.
The United States will once again consider itself a growing nation, one that increases our wealth, expands our territory, builds our cities, raises our expectations. The golden age of America begins right now.
Live from Davos, Switzerland, for our audience worldwide, it is day one for us at the World Economic Forum. Equity futures are positive. There is tons of volatility in the FX market that we'll be discussing throughout the program. Under surveillance this morning, it's the golden age for the U.S. economy.
The United States will once again consider itself a growing nation, one that increases our wealth, expands our territory, builds our cities, raises our expectations. Our recent election is a mandate to completely and totally reverse a horrible betrayal and all of these many betrayals that have taken place, and to give the people back their faith, their wealth, their democracy. The golden age of America begins right now.
The golden age for America begins right now, and we've already had the conversation already in this program in the last 10 minutes. For America, what about, Lisa, for everybody else?
Everybody is going to lean in to America and basically hope that that will trickle back to them with maybe diminished tariffs, and that seems to be at least the hope in Davos.
Joining us now to discuss, I'm pleased to say, Becky Frankiewicz, the Chief Commercial Officer for ManpowerGroup. Becky, good to see you.
Thank you. Nice to see you.
You've been here a few times.
I have.
This is a different Davos.
This is a different Davos. I mean, growth is topping the agenda. Practical approaches to things like AI and green are topping the agenda. So it's quite a different year.
What's changed? It feels like ahead of this event, we saw from various companies in America, they were pulling back from DEI initiatives, distancing themselves from things like ESG, net zero. What's behind that? Just one man, one shift, or is it much bigger than that?
I think that it's a shift in how people are thinking about the workforce. But the truth remains, diverse talent is what drives better results. That's still proven. It's still true. So I think companies now, as we talk to companies around the world, they're saying, we're not going to lead with it in terms of our marketing, but we're still going to do some of this behind the scenes because we need to have workers in the workforce, and we're not getting a new population.
There's a question about that new population, immigration, and how much that's going to potentially upend some of what you track every day, which is the labor market in the biggest and the most dynamic economy, and that is the United States. How much is that top of agenda for the people you speak with?
Yeah, I would say really not at the top of the agenda. If you think about the labor that's coming into, it's a lot of jobs that historically are not tracked in the BLS, indicators. And so I do think it's going to cause a tightness of the labor market to get even tighter than it is today. And that is something we have to keep an eye on as employers. What happens to wages in that environment? What happens to flexibility in that environment? So I do think we'll see a tighter labor market if the immigration reform, not just reform, but the challenges that, we're going to start deporting people if that actually happens.
So this actually is a real question that people have, just how tight the labor market actually is at a time when some people, at least as recently as last November, were talking about a weakening U.S. labor market. Are you saying that the tightness is still there and that just a little bit of distortion from immigration could really cause wage pressures to arise anew?
Yeah, so first I would say the U.S. labor market has been the most resilient labor market in the world. No question, hands down, most resilient. We've held unemployment fairly steady, workforce participation fairly steady, and we haven't overheated at numbers that traditional economists would say would be overheating. And so that'd be the first thing I'd say. Second, any pivot, boomers retiring, any loss of workforce participation is going to be a challenge, particularly with skills assessment and the fact that we need new skills for, new technology.
Can you build on that? What is the talent gap like right now?
Yeah, so we just did a survey globally and in the U.S., and over 3/4 of employers are saying they can't find the talent they need. Now, talent they need could mean quantity. It can also mean specific skills for new roles. And so we're seeing a two-sided pressure. We don't have enough population, and we actually need specific skills. And we need to upskill and reskill our workforce with an employee who feels more empowered than ever post-COVID.
Are they worried that they might not be able to import that talent in the years to come?
Yeah, very, very concerning. We'll be keeping a close eye on H-1B and what happens in that environment. But having talent where we need it, when we need it, John, will be the question. If you look at global population growth, the U.S. continues to hit 100-year lows every time we measure. People aren't having as many children, people are marrying later, et cetera. So the talent that will grow, where population will grow, will be in Africa and India, places where we may need talent in developed economies, but it's not going to be there. So reframing how work works is going to be important.
How different is the conversation, though, now, given that there is a very different tone at Davos, and it's not about bringing up people who are the downtrodden and trying to equalize wealth across the world? There is a different tone. How is the conversation different in this area?
I'd say a different tone and a different pressure, Lisa. Growth is going to create demand. And demand is going to create demand for talent, and then we're going to be back to a tight labor market. So I would say the tone is more optimistic, and your opening comment around, what about the rest of the world? The rest of the world's also looking for this as, hey, if there's U.S. growth, I want a piece of that. Now, what happens with tariffs, to be determined. Obviously, we hope a pretty moderate approach to that so that we can stimulate U.S. manufacturing and also stimulate good competition.
What does that look like? Can you develop what that means? If they want a piece of that, is that hiring people in the United States to be part of Wings? Is it to basically emulate some of what's going on in the United States?
Yeah, I think it's going to be both, actually. So I think we're going to see the global economies, all eyes are on the U.S. So we will have students of what growth looks like in the U.S. And, of course, we will have companies, multinational companies with outposts in the U.S. that are looking for their share of this growth within our borders. And so I think it's actually optimistic. It's the most optimistic confidence I've seen. Now, my question is when that confidence translates to action, and that's what I'm waiting for. And I think that's what the U.S. labor market's waiting for.
I think we're all waiting for that. Becky, it's good to see you.
Nice
Great
to
catch
see you.
up. Thank you for your time. Becky Frankiewicz there of the ManpowerGroup on the U.S. labor market. Another voice from the United States feeling pretty good about the situation right now. As for everybody else, the Mexicans, the Canadians, and maybe the Europeans and the Chinese in our future, I think they're a little bit nervous still about what could be coming from Washington, D.C.
Well, yeah, you can see that in the Canadian dollar today. You can see that in the Mexican peso and the really quick response to that headline of a potential increase, 25% starting February 1st. But again, how much becomes reality and how much is this a negotiating tactic? We're going to be having that conversation.
We've been trained on this. We know how it works. We saw it in Trump Volume 1. You don't get too excited. You wait to see what the man himself has to say.
Yeah, unless you are a trader, in which case you go out and you trade immediately.
Or a journalist getting excited about writing headlines.
Okay, well,
they're going to take a measured approach. 12 hours later, the headline's redundant.
Okay, well, are you basically telling me to be a little more measured?
No, not
the world's coming to the end.
You're just like, deep breath, deep breath. Things will change quickly. Up next, the former IMF chief economist, Ken Rogoff from Davos, Switzerland. This is Bloomberg. Been very choppy overnight in the equity market. Equity futures breaking lower off the back of those comments from President Donald Trump on the prospect of levying some big tariffs on the likes of Canada and Mexico. We've recovered since then, positive by 1/3% on the S&P, building on last week's gains. Last week, one of the biggest weeks we've seen since election week on the S&P 500. Let's take the opportunity to get you some morning movers. We can do that with Manus Cranny. Good morning, Manus.
Jonathan, and helping some of that duration in big tech is, of course, the drop in yields. One of the big tech stories that has not gone unscathed is Apple. Sales in China of the iPhone down 18%. Taking their holiday quarter globally, Apple iPhone sales down 5%. Who's stealing their lunch? Who's stealing Tim Cook's lunch in China? It is Huawei. Why? Because of the AI functionality that is not on the generation of iPhones there. By the way, just look at the lineup. Danny and I were talking about this morning, of those tech bro CEOs that were sitting directly behind Donald Trump. And this is something Danny and I chatted about this morning. Cook was there, Zuckerberg was there, Bezos was there. But there was one CEO that we don't believe was there, and that is the Intel CEO. It's interesting. This stock had a storming Friday, up 9%. We add to that this morning. What do you want to add to this story? Is it a takeover target? What is Frankiewicz going to do with the company? The worst case scenario for tariffs have not been implemented on China. I mean, you can throw any dart at the board. Right now, you've got a building narrative that there may be something afoot in terms of the M&A space there. But if you're not on that front-seated row behind Trump, maybe your access to power is a little bit more limited. GM, nice upgrade this morning. Deutsche Bank raised the target to $60 from $56. Going to be delivering high end in the guidance, consistent execution, and they are aggressive in their share buyback trajectory. That's the assumption from Deutsche Bank. But of course, the EV market, they've got about 9.5% of the EV market here. Again, going back to those edicts, potentially from this new White House. Revoking the electric vehicle mandate is going to be top of those executive orders. Jonathan, Lisa, good morning.
Manus Cranny, good morning to you, sir. Appreciate it. So much talk about the dream team lined up at the inauguration. What did you make of that, Bramo? There's been a lot of pushback about that. All these questions being asked. What do they want? What are they getting? What do they want? What will they get for this donation? We never asked these questions of Democratic donors over the last few years.
It's practicality. It's essentially that if you have some voice to the ear of the president, Donald Trump, that you have a better position for policies. That has always been the way that it's worked. It just is much more clear. It's much more explicit this time around. And I think that that's what we're hearing in terms of Davos this year as well. Anne-Marie's down in Washington, D.C. She was following the coverage, looking at the good and the great of corporate America. Anne-Marie, what's your response to some of the questions that are being asked about Team America assembled out of Silicon Valley over in Washington, D.C.?
Well, I think you could be a cynic, of course, and say, well, these are a lot of individuals who want to make sure they are close to power. They are looking at what Elon Musk was able to single-handedly really do over the course of the election campaign. And now he's going to be given a White House, basically a separate email account, as he tries to bring government efficiency to the U.S. federal government. And you see the likes of other CEOs saying, well, this might be good for my business as well. On top of that, I think back to what Mark Zuckerberg said to Joe Rogan when he was talking about this isn't just about making sure we have good communications with whoever is in power. And Jonathan, you are certainly right to point out we've seen this with Democrats as well. I think back to that EV day Biden did, and he had all the EVs he likes because they were made by union workers. But I think back to what Mark Zuckerberg of Meta said, who we've seen him really markedly move the company to the right of where they were with adding Dana White, for instance, to the board. But he talked about the fact that it's really important that foreign governments do not have access to our data. And you've heard Trump talk about this in the past, that to make sure that the United States has its own national champions to combat not just its adversaries, but also some of its friends. And you think about some of the challenges a lot of these tech companies may face in places like Europe when it comes to regulation.
AMH, appreciate your time. We'll catch up with you a little bit later, no doubt. Anne-Marie, in the nation's capital, I think we should build on what Mark Zuckerberg said in that Joe Rogan podcast only a week or so ago, when he talked about the Europeans going after US tech firms and how perhaps the administration, the Biden administration, gave the Europeans cover to do so because equally they were as against them. This is going to change a lot, I would imagine. I think people think that's going to happen, Lisa, over the next 4 years.
And it goes to this point of the race, the technological race, and who's going to win it. And it goes to the question of why Europe has fallen behind. It has been some of the investment in technology, the enablement of it to experiment with certainly constraints, but also to push the boundaries just a little bit. All of a sudden, it's a different conversation. And how much do you see that getting sort of accepted by others that are not in the United States?
What's the line? The US innovates, China replicates.
Europe regulates.
Yeah, and maybe the Chinese can push back against that. I'm not sure the Europeans can, based on recent history.
Yeah, and it seems like there is a greater acknowledgement of that here. What I thought was noticeable was some of the foreign companies, corporate executives, are not sounding negative toward Donald Trump. They are not sounding negative toward policies that in 2017 they were. They're saying, actually, maybe we need to take a page from this and do something similar in Europe, elsewhere. And that, I think, is a huge shift.
The American bankers are really fired up about the future of the U.S. economy. You've already heard it from Citi. Jumana Basechi sat down with Mary Erdos of JP Morgan Asset Management, Wealth Management, said exactly the same thing. Joining us now to discuss that is the former IMF chief economist, Ken Rogoff. Ken, it's good to see you, sir.
Good to see you.
You wrote a piece in the South China Morning Post, I believe, questioning whether we could see the same boom this time around as we saw last time around. And I want to be clear, and I'm going to do this for you and give you some credit. Back in 16, 17, you weren't pessimistic on the Trump economy going into it. You were somewhat constructive. Your peers were very, very downbeat. So what's changed for you personally?
People were unhappy when I said that, but I think it was closer to true than not. Well, I mean, for one thing, if we're just looking at policies, the things that he did in the first term, I think on the whole, were constructive, as you say, for the economy. Deregulation, the tax cuts, getting rid of the state and local deduction, I think, was actually a good move over the long term. And this time, every campaign promise practically is something counterproductive. I mean, you could go to the tariffs, Social Security being not taxed, and on and on and on. So, it's less obvious that he has the same room to run with his policies. And when he came, interest rates were zero. Now they're not. Our bill for our debt was, a couple $100 billion a year. Now it's pushing $1 trillion. So he has a lot of constraints that he didn't face the first time. So I don't think we can expect quite the boom that we got the last time.
Ken was doing a panel at the World Economic Forum a little bit earlier this morning. Fantastic lineup. And you were also alongside Rajan, who we'll catch up with in about 5 or 10 minutes' time. You mentioned that we're now spending more on our interests in America than we are on our defense. Do you think we are at that tipping point where this becomes problematic, or are we not there yet?
We hit it a while ago. I mean, I don't know about tipping point to crisis, but interest rates had been going down and down in the whole world, and I'm sure you interviewed them here over the years, secular stagnation, lower forever. That's very ingrained in the mindset, and it meant in Washington and a lot of policy think tanks at the central banks, debt is free, nothing to worry about. But when the interest rates are this high, then you start to have to think about it. I mean, so we're running a 6.7% deficit on top of our, $35 trillion debt. You start to pile up an interest bill. And I think we've reached a moment where things have changed. It's the interest rate that's turned. It has happened. It's not Donald Trump. I think it would have happened just as much if Harris had won.
And you point out that right now, where interest rates are would add 2 to 3% to the deficit in the United States over the coming years, just based on where rates are currently. Do you think they will stay here? Do you think that they're going to go up? You said, last time we spoke to you that the Fed couldn't necessarily cut that much. Can they cut again? Are they going to have to hike?
Well, let's start with the long-term rates. I don't think they're going lower outside of a recession. In fact, if I had to look at the arc of the next 5 years, I think we'll get another burst of inflation sometime within the next 5 to 7 years. And this time, we will not get a free pass. Inflation expectations will go up and interest rates will go up even more. But for now, I think they're settled, around in the 4.5, 5 range that they're probably going to stay, maybe in a recession going down. I mean, the Fed's a different matter. But my guess is where we are at the moment is the odds of a hike are as good as the odds of a cut. I think the Fed was way off the mark on where the neutral interest rate was, and that's what I found in my research, and they're adjusting. They're starting to see that, and I don't think it's just what's going on this second. I think it's a longer-term phenomenon.
You were very positive on the potential for the first Trump term. You're much less positive this time around, as John was mentioning. And I'm just wondering what that lack of positivity looks like in contrast to all the optimism we're hearing from all the bankers.
So just to be clear, I don't have Trump derangement syndrome. I try to have an objective.
We're not accusing you of that.
I try to have an objective,
We tried to give you that pass
but
earlier.
We're starting at a very strong
This is
economy.
a TDS-free zone.
So the question,
don't worry.
and we've been booming for a while. It's a different picture, somewhat than when he came in before, and so just based on that, it's not as obvious that it would do well. I wouldn't quite say a recession's around the corner, but it's not as many miles away as it was, at one time. But also I think certainly corrections to some of the things Biden did are welcome. I get it why so much of corporate America feels the Wicked Witch is dead, and now they can finally breathe freely on a lot of different dimensions.
Can we drill down on that just a little bit? I understand it. The Wicked Witch is dead. He was hardly warm and fuzzy with corporate America. GDP was pretty decent. These guys were spewing out record profits quarter on quarter. Many of them were. What is actually going to change fundamentally to the underlying economy? GDP growth, corporate profits?
Well, the sustainability of what's going on is highly questionable. So, yes, GDP growth was good, but we have this massive deficit we're running. All these Keynesians were saying the multiplier's 2. In other words, for every % deficit you run, you get 2% growth. We're running double the deficit, more than double that we're getting in growth now. The immigration was probably larger than the official numbers by a considerable margin, and that also is contributing to growth. These things are not sustainable, but so it's true. You're right that some of what's going on was going to run out at some point. So it's a more difficult situation that he's inheriting.
The debt story is terrible. We all agree on that. Any evidence that people are pulling back from the US dollar and dollar-denominated assets with that in mind?
Well, the interest rate is the vote that they have. So I think our markets are very dollar-oriented. Over the very long run, there could be more fragmentation. The Chinese don't like the system. You heard the session I was in this morning, and Kei Jin, who's a great, brilliant economist, originally from China, was talking about everything they're doing to build away from the dollar. If you go back to the 60s, Europe was moving towards trying to have its own currency in the dollar before it broke off. A lot of things were starting to be denominated in Deutschmarks. So, there's some gradual movement, but the big thing, certainly is that the interest rates are going up, and people are requiring more. If they love the dollar so much, why don't they love it at 1.75% for the 10-year, which is what they were taking, 5 years ago?
This is something that a lot of people were talking about, that the U.S. can afford to borrow more and more if the dollar is strong. You wrote a book about the dollar and the loss of its reserve currency status. Is it getting closer as a result of the deficits that we're seeing right now? Are you seeing that time frame brought forward?
So I have a book coming out in May called Our Dollar, Your Problem that deals with this. And some of your colleagues may have seen, some early version. But, the dollar has just soared beyond anything people expected. There were several turns, not just the value, but its footprint. But surely over time, there are forces that are going to push that back. Crypto may not take over the legal economy, but the illegal economy, the underground economy, which in my work I find is 20% of the global economy, that's up for grabs. And China clearly needs to pull away. If China pulls away, then it pulls other people with them. That's a slow process, but yeah, I think we've had a great run. It's not over, but we might be looking at a little bit less exorbitant privilege in the future.
Ken, we could talk all day, but we're eating into Raghu's time, so we've got to go.
Don't want to do that.
Good to see you, sir.
Thank you.
Catch up. Thank you. Ken Rogoff there, the former IMF chief economist, and so much more. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Yemen's Houthi rebels say that they will stop attacking U.S. and U.K. vessels in the Red Sea. It's a response to the Israel-Hamas ceasefire agreement. In an emailed statement, they said that ships belonging to U.S. and U.K. individuals or entities are no longer subject to sanctions. However, the Houthis warned that ships owned by Israeli entities or sailing under the Israeli flag remain banned. President Trump temporarily halted a ban on TikTok. In an executive order, Trump gave ByteDance 75 more days to find a buyer that resolves national security concerns. Trump said he could see a deal where American companies own half of TikTok to police it. TikTok CEO So Chu was among the tech CEOs in attendance to Trump's inauguration. Elsewhere in tech, Meta says that it will continue to use fact checkers outside the U.S. for now, despite replacing them with community notes in the U.S. CEO Mark Zuckerberg said that he is replacing fact checkers because of mistakes and unfair censoring. Meta's head of global business, Nicola Mendelsohn, told Bloomberg at Davos that they will watch how the transition shakes out in the U.S. before deciding on other regions. And that's your brief. John.
Danny, thank you. Up next on the program, risks ahead for global trade.
Protectionist measures are negative for global trade, and global trade is the lifeblood of the global economy. To the extent that the measures taken are inflationary, it could slow down the disinflation process.
Did anyone in this market actually get a long weekend? I imagine most of you were just glued to the TV screens yesterday waiting to see a change of policy from the incoming administration. This market got whipsawed, ex-US, particularly in foreign exchange. Equity futures right now with a lift up a third of 1%. The bond market bid yields down 4 basis points. Let's call it 460. But Lisa, in foreign exchange, what a 12 hours.
And basically, the initial was some sort of dollar weakness across the board, euro strength with the expectation that maybe the tariffs would be rolled back or not as strong as they previously had been expected. And then, bam, out with the Mexico and Canada tariffs to be implemented by February 1st. And all of a sudden, those currencies underperforming dramatically. And it just speaks to what we can expect in the weeks and months ahead.
Under surveillance this morning, risks ahead for global trade.
Protectionist measures are negative for global trade, and global trade is the lifeblood of the global economy. To the extent that the measures taken are inflationary, it could slow down the disinflation process that the central banks had so steadfastly worked on since the great inflation of 2022.
Lisa, you picked up on this. Companies, officials, across the board, governments, they've all got to have a plan for how they're going to respond to this. We're going to see some big changes. They might not materialise, but the threats will be there. And behind the scenes, they're working through this. We'll go back to that comment that we heard from Mary Otis of JP Morgan, speaking to Jumana a little bit earlier this morning at the World Economic Forum. They've got a war room, hasn't everybody? They're all waiting to see what's going to change and trying to understand what it means for everybody else.
And right now, a peace offering as they try to get ahead of it with at least niceties. And that seems to be the theme that we hear, at least among corporations and, frankly, even government executives.
Another great conversation lined up for you right now on Bloomberg Surveillance. Joining us is the former RBI Governor, Raghuram Rajan. Raghu, it's good to see you, sir. Great to catch up.
Likewise.
Let's talk about how upbeat everybody seems to be about the future and how you've got a word of caution. And I want to go back 5 years. Sat here in 2020, watching some Chinese cities close down, watching Chinese equity markets break down, and a lot of people didn't really seem to understand the scale of the problem or the magnitude of the response that would be required. And we have hardly done any cleanup since then. We spent trillions. How concerned are you about something bad going wrong again and we've not got the ammunition to tackle it?
Well, that's a real issue, right? Think of global financial crisis. We spend about 15% of GDP across the G7 countries. Pandemic, another 15% of GDP. 15%, it adds up. We're now north of 100% of GDP in terms of public debt in all these countries. How much more space do we have if something really bad happens? And it could be pandemic, it could be a war, it could be something else which we can't think of now, a big calamity of one kind or the other. So good times are when we create the space for the bad times. Are we creating the space? We certainly need to do more.
There is a question about preparing for the downturn. And then there's a question about how much the amount of debt that we currently have is a limiting factor to some of the optimism that we're hearing right now from a lot of corporate executives. Which is it?
Well, I think we have some time to go before things really turn ugly, right? I think the U.S., for example, the question when people think about safe assets is where else will you invest? The euro area has its own problems. Japan is very highly indebted. And of course, China, there's the geopolitical risk in investing in Chinese assets. So I think the U.S., both from the equity markets and the bond market, looks reasonable, as we heard in a session this morning, an ocean of stability. But of course, there are things gnawing at the edge. We're seeing in the U.S. Credit card delinquencies pick up. We're seeing student loans. You remember the moratorium? And now we're soon going to get to the end of the year, at which point a lot of student credit will start coming out in the open. So things to be a little concerned about.
As someone who has headed a central bank, how much ammunition do central banks truly have to cut rates at a time where inflation is still a problem?
Well, I think the real question in the United States is, how much the Fed is fighting the fisc. Right, there's a lot of fiscal stimulus out there at 6.5% to 7% of GDP, and perhaps more to come. And of course, the Fed has been trying hard with higher rates. But if you look at financial conditions, they really haven't tightened, partly because asset prices have been quite ebullient, and credit markets have been quite supportive. So the only place where you see real tightening is in the mortgage market, 7%, north of 7%. Yeah, nobody has the money to buy at this point or can afford to buy. But elsewhere, it's very hard to see signs of tightening. So you're seeing some of the deterioration on the edges, as I said, with credit card debt. But in general, the Fed, is not getting the economy to slow to the extent it wants. Labor market's still strong.
It's interesting when you think about a domestic neutral and a global neutral. If the Federal Reserve was the central banker to the world, we are very much sufficiently restrictive. What's your advice to foreign governments in the United Kingdom, governments and officials across emerging markets as well? You might consider the UK in that bucket. I don't know. Maybe things have changed that much.
Oof, are you ever planning to go back?
I don't think Raghu's going to go there. What's your advice to them now as they start to see their currency depreciate specifically against the US dollar and yields push up specifically because of what's happening in America?
Well, the problem in many countries is everybody benchmarks against the US. So in India, for example, the price of the rupee versus the dollar is a big political issue at this point. Why is it depreciating so much? And you can tell them all you want that it's the dollar is strong, it's strong against the euro, it's strong against everybody, but people will look at the rupee dollar. So central banks are coming under pressure on the one side from seeing their currency depreciate. On the other side, a number of these economies, as you put it, are having a problem with growth. They would like to stimulate growth. Growth in India, for example, has slowed recently in the last quarter. So, yeah, they would like to stimulate, but they have their eye also on, what happens to the currency, especially if we see an environment of tariffs. And, to some extent, currency adjustment is necessary, but they want to be careful about it.
Raghu, it's good to see you. Great to catch up. Thank you, sir.
Thank you very much.
Rajan there, the former RBI governor. That's the first hour of Bloomberg Surveillance. In the second hour, up next on the programme, we'll catch up with Josh Friedman of Canyon Partners, Ed Mills of Raymond James, Mitchell Green of Lead Edge Capital. Look out for that ByteDance investor. That's going to be an interesting one. And we'll catch up with Steve Tananbaum of GoldenTree Asset Management. Live from Switzerland, you're watching Bloomberg TV.
Thinking in terms of 25% on Mexico and Canada. I think February 1st. Zelensky wants to make a deal. I don't know if Putin does. He might not. I think he's destroying Russia by not making a deal. I have to speak to President Putin. Essentially, with TikTok, I have the right to either sell it or close it, and we'll make that determination. And we may have to get an approval from China. NATO has to pay more money. NATO has to pay 5%. World Health ripped us off everybody rips off the United States. And that's it. It's not going to happen anymore.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
We are so back, and you can decide whether that's a good or a bad thing. There is only one Donald Trump, the sitting president of the United States, sitting there in the Oval Office, signing executive orders, Lisa, and then just sort of going toe-to-toe with the press about doing a whole range of things. If you want a snapshot of what this looks like in financial markets worldwide, one currency pair. Dollar MEX right now, Lisa, all over the place, whipsawed by these comments.
Yeah, initially, they're not going to be tariffs in the first 100 days, or at least not initially. He was going to hold off on that, and then, bam, February 1st, get ready for 25% tariffs implemented on Canada as well as on Mexico. And you could see that just currency surge, Mexican peso, and then losing it all. It just speaks to the headline volatility that we could expect in the torrent of potential options that we're going to get.
Sitting here in Happy Valley on day one for us at the World Economic Forum, every single conversation you have, doesn't matter who you bump into, what panel you drop in on, every single time the first question is not about Davos, Switzerland, the agenda. It's about the United States, the incoming administration, and Lisa, the changes we'll see in the next 4 years.
And it's such a different tone than in 2017. We have to keep going back to that. Becky Frankiewicz saying that right now it's about growth and practicality. Those are not usually words that you hear about from Davos. It's usually about either hype, if you want to go to the growth side, or save the world. What is your agenda? How are you going to make the world a prettier place? Those things are not necessarily on the topic. It is data, it is how to get into the U.S., and it is how to grow your business. And that's the basic agenda here.
All eyes on Washington, D.C. Let's head over to the nation's capital and catch up with Anne-Marie. Anne-Marie, that was one hell of a 24 hours. What's day two got in store? What's on the agenda?
Absolutely, it was. And we've seen a slew of executive orders. Jonathan, I don't imagine those are going to stop just yet. But what we do know is that today, President Donald Trump is going to meet with congressional Republican leaders. So Speaker Mike Johnson and Senate Majority Leader John Thune will be heading over to the White House. This is where it's going to get interesting in terms of his agenda domestically. Remember, this is going to be a very difficult road ahead for those in Congress to try to pass through Trump's agenda. When it comes to the House, first off, we have to note that March 14th, the government may shut down again. They're still working on a stopgap funding measure. All that drama that we saw at the end of 2024 has bled into the start of 2025. By the summer, given the fact that Treasury is using extraordinary measures to pay our bills, they're going to have to raise the debt ceiling. On top of that, they really need to hone in on the process for Trump's agenda, whether or not they're going to use one bill, one big, beautiful, powerful bill, as the now 47th president likes to call it, or a two-bill approach. And that's what the conversation today is likely going to look like. What is the process going to be when it comes to things like more money to the border, deregulation, and, of course, those tax cuts?
Anne-Marie, stay warm in Washington. I can't believe I'm saying that, sitting here with the snow and the mountains behind me.
Honestly,
but it's warmer here than it is there on the East Coast.
That's true, actually. There's a cold snap.
In D.C. and in New York right now, right across the East Coast, it is much colder there than it is right here, which is kind of bonkers, right?
Well, you know, it's nice to be here. Sorry.
Let's get to the conversation, not about the weather. We've got so much more to talk about. Josh Friedman, the co-founder and co-CEO of Canyon Partners, joins us now for more. Josh, good to see you, sir.
Thank you very much. Nice to see you.
Thanks for dropping by. We've heard from Citi, from JP Morgan. They are super fired up about the US economy in the year ahead. Do you share that sentiment?
Yes, I think the inaugural speech was essentially an advertisement for investing in America. If you try to get away from the specifics of the speech, it was a great storytelling example. And it was advertising tech. It was advertising the energy industry. It was advertising that America is open for business and is going to be a premier example of a business-friendly environment for the next 4 years. And I think that's why you're seeing that optimism.
I could not agree with you more. A lot of people had all these questions about the tech CEOs being lined up at inauguration. What did they want? There were all these skeptical, cynical thoughts, no doubt coloured by some kind of partisan bias as well. I felt the same way, that it was an advert for the United States of America. It was Team America, the best of the United States. Are there opportunities for you? Because right now, a lot of those valuations feel pretty full in public markets. Give us your perspective of what you see in private markets.
Well, if you look in private markets, first of all, private markets are now larger than public markets in many respects. The number of public companies has shrunk at the expense of the number of private companies. And if you look at the credit markets, the private credit markets, particularly private lending, has eclipsed all the traditional sources of lending, or is in the process of eclipsing those. So there's been tremendous change. And I think if you look at this as an open invitation to have more mergers and acquisitions, you have to think there are going to be more financing opportunities. And I suspect that'll be the case. I think antitrust will be much weaker this time around. I think mergers will increase. And we'll see what happens with interest rates, because one of the barriers to M&A is high interest rates. And if Trump makes progress on the budget and there's a bit less inflation, perhaps because of energy prices, perhaps because of productivity increases, then you could see interest rates fall more than the market expects as well.
That's where I wanted to go. We're hearing about all this optimism, and then Ken Rogoff comes on and says, hold on a second, you have to think about the interest rates. You have to think about inflation, where we are now versus in 2016, 2017. You have to think about all this growth and optimism and what that's going to do to keep inflation sticky. How much does that make you less optimistic about credit markets right now than, say, even equity markets, based on that constraint, the idea that base rates cannot come down all that much?
Well, you have to distinguish between the short end of the curve and the long end of the curve. The Fed has a lot more control of the short end than it does over the long end. For the longest time, I've been a contrarian, particularly with respect to the long end of the curve, because I felt that inflation wasn't over. And I felt that as long as the stock market was super strong, which it was, and as long as unemployment was super low, which it was, why should the Fed spend its limited number of bullets lowering rates prematurely and trying to fuss with that when it might need those at a different time? Lately, I've actually been out of consensus, I think, the other way a little bit. And I don't have as much conviction this time, because I think that it's hard to really have a crystal ball about inflation right now. I think it's a much less certain picture. A lot of the Fed officials see it coming down. We do see these productivity gains. And when everybody and his brother is saying maybe they're going to raise rates, it makes my little contrarian alarm bell go off and say, well, maybe they're just wrong, and maybe it comes down a little faster than we think, particularly if there's progress on the budget deficit.
How much, I know you say you don't have that much conviction, but how much does that make you lean into credit all the more, even if you do have, as John was mentioning, pretty fully valued types of markets out there?
I think you have to distinguish between where you lean into credit. Spreads in the high yield market are tiny right now. They're at lowest levels they've been historically for many, many years. And the big fat part of the private credit market, the large unitranche lending that you see from some of these hyperscaled alternative investment shops, has gotten maybe a little too popular, and spreads have gone from 675 to 600 to 500, now to 450 or 4.25. And the competition is based on rate, poor covenants, and amount of debt on the same assets. That's not a formula for success. And on top of it, acquisition activity has been somewhat muted, partly because of high rates, partly because of expensive prices, and therefore a lot of money sitting on the sideline chasing the same deals. By the same token, I think if you just take one step back in size, one step up in complexity, it's a completely different picture, because those same large institutions have really chosen where they can scale their businesses the largest, which is the large cap deals. So if you just scale back a little bit, I think there's quite a bit of opportunity, almost irrespective of your underlying view of rates. By the same token, I think Europe's become an area that's probably 80 basis points more attractive in general in acquisition financing, and also has less debt per dollar of EBITDA, and also has better covenants. So I think you try to look around the board and say, where have people moved to a different place and abandoned something that might be attractive? Where might there be more activity going forward? And I think these are areas where one should look.
Well, you've taken us to Europe, and you like to be contrarian. We came into this year and a lot of people were very downbeat on the European economy. What is it you like right now? And of course, that's relative to valuation and to price. Where do you find those deals?
I think there's slower growth for sure. And I think governance in the U.S. has always been about as good as it gets, subject to all the qualifications about creditor-on-creditor violence and all the dysfunctional behavior we see sometimes in these particularly distressed or loan extension fights. But in Europe, I think it's still a little more old-fashioned market. I think the crush of capital hasn't quite hit it the same way. And I think Europe continues to be a functional, rules-based economy. Each economy is a little different. The UK is a little different from Germany, from France, from Spain, from Italy, etc. But I think generally in Europe, spreads for the same quality company and for the same growth profile are higher. And I think the covenants are better. And I think the rule of law is not so bad. So I think Europe, particularly for slightly more bespoke, slightly smaller opportunities than the mega deals, continues to be an excellent area of opportunity.
I love this. You're actually the second person who's mentioned this, that maybe actually Europe is going to be the bright spot because of the low expectations. And I just wonder how much you're transitioning to Europe versus just adding a little bit on the edges whilst trying to still play in some of the M&A that you expect to come down the pike.
We're still playing a lot in the U.S., and there are still a lot of over-leveraged capital structures left over from the last period. By the way, in a lot of asset classes, it's true in real estate as well, where you have companies that, or people who financed real estate transactions based on very, very low cap rates, and some of that debt's maturing, and the assets, even if they're very good quality assets, can't necessarily handle today's interest rate environment. So I think in real estate, in asset-backed securities particularly, as well as in some of the more leveraged private equity-sponsored deals that were put together in the last 5 years, there's a problem because refinancing isn't so easy in today's rate environment. In certain cases, the equity market comes to the rescue and means that the sponsors have to keep those capital structures alive, and they don't want to lose their option to have upside. But in other cases, there are going to be some restructurings, and we've continued to play, but selectively. I think it's...
Journalists love this question, Josh. Is something going to break? Are things going to break? You're describing something that might break. We got a little mini episode of a mini crisis in the regional banking system a couple of years back. You're expecting a similar episode in the next year or so?
I don't think there's systematic breakage in the corporate world. I think the asset-backed world is somewhat devoid of the kind of capital it had, and therefore the returns are much higher than the ratings would normally command, and that's an excellent area. And I think real estate, it is a little broken, partly because the banks that would normally come to the rescue are under severe capital restraints. And it really doesn't matter if you're Citibank or JP Morgan or if you're a regional bank. A lot of the rules govern all capital deployments for all of these banks. And the capital reserve requirements are exceptionally high. So I think that traditional lenders to real estate really can't engage in the types of financing they used to engage in, and that leaves a lot of open territory for alternative financing.
Big 12 months coming up, and hopefully we can talk again soon. Appreciated this. Thank you, sir.
Thank you.
Josh Friedman there of Canyon Partners. A lot's going on in Davos, Switzerland at the World Economic Forum. We also have another location here in Switzerland. We have our very own Bloomberg House. And sitting down right now with the editor-in-chief, John Micklethwaite, is the UBS CEO, Sergio Ermotti. Let's take a listen.
Domestic consolidation. Yes. I mean, where the main driver of value creation is domestic. So European banks, we have been saying that for a while, won't be able to compete if you don't have a first banking union and a capital market union. Look at the balance sheet of European banks. We are still, and it's not an issue, but we are still basically financing a lot of things that in the US are financed by capital markets. So a lot of the resources banks use are going to different businesses and not necessarily in terms of profitability, better performing ones. For one unit of risk, a US bank has a higher return than, on average, a European banks because of the role we play in the economy and in the system. So fundamentally, but in order to mobilize resources to transform Europe, to go through the transition in terms of climate changes and the investments we need to do, we need to free up resources that are not effectively used. And capital market union.
If you are just tuning in, welcome to the programme live from Davos, Switzerland at the World Economic Forum. It is officially, I think, day 2, but it's day 1 for us here on Bloomberg Surveillance. Check out the equity market first. Lots of volatility, certainly not caused by anything that's happening here. All of that is coming from Washington, D.C. Equity futures at the moment positive by 1/3%, building on last week's gains. But it's these moves in foreign exchange, Lisa, that get our attention. The move that we're seeing in the Mexican peso, weaker. The move we're seeing in the loonie, weaker off the back of comments from President Trump.
Essentially, tariffs, strong dollar. Tariffs delayed, tariffs brought back. Then you get some strength from other currencies. This is the whipsaw we're going to see. I just wonder, just underneath all of the optimism we're hearing from all these executives, how much this uncertainty plays into a lack of conviction, because we're not hearing it.
If you're in the United States, and we've talked about this repeatedly, things are good. And if the wars go up and it gets harder to import into the United States, whose problem is that? If you're in America and they're going to run the economy hot, this is why all these guys are so fired up. What we heard from Citi, I thought was really instructive. We heard from the head of banking at Citi, and he made the point that these US companies have got really buoyant valuations right now, and they might use some of that equity, backed up by a stronger dollar, to go on a bit of a shopping spree around the world, maybe in places like Europe. And that's the side of the M&A story that I don't think we've talked about nearly enough over the past month or so.
And part of the reason why is because we're not sure what the potential consequences could be of getting exposure outside of the United States at a time where this is a president that's really emphasizing American first. And you could hear that from the head of banking, from Citigroup. So it just speaks to this question of what the fly in the ointment is underneath some of this optimism.
Under surveillance this morning, front and center, Trump's tariff plans.
We're thinking in terms of 25% on Mexico and Canada because they're allowing vast numbers of people. Canada's a very bad abuser also. Vast numbers of people to come in and fentanyl to come in.
When do you think you would enact those?
I think February 1st.
Anne-Marie is at the epicenter of the world right now, the universe of financial markets and global business. Anne-Marie, I've said it a few times. It's certainly not here. It's where you are.
Certainly is where I am, and that is what everyone is taking notice of. What is going to be happening in Washington, D.C., a flurry of executive orders. What was so interesting, though, is there was a bit of a light touch when it came to trade, even though, as on the campaign trail, Donald Trump talked about day one, the walls would be going up. Well, it looks like they might be taking a more nuanced approach, especially when it comes to China. China was not in that soundbite right there when the president was going back and forth with our very own Josh Wingrove. I want to bring in now, Jonathan, Ed Mills of Raymond James, who's been looking into this. You were just in Canada, so everyone's asking you a ton of questions. What are the tariffs going to look like? February 1st, though, is just around the corner. Why, though, is he just starting with Canada and Mexico?
Well, in that executive order that outlined the trade policies of the president, China was in every area where Canada and Mexico were mentioned. He just didn't mention it. Most of the deadlines in that trade executive order are April 1st. I would expect that really to be the deadline. But I think that is classic Donald Trump. He gets asked a question. He's going to move the goalpost. He's going to tell you it's happening sooner. So we all wait to find out what's next. I probably do not anticipate tariffs coming on February 1st. But do I anticipate tariffs coming on China, Mexico, Canada, the rest of the world sooner rather than later? Absolutely. How long they stay on, does he cut a deal? Those are going to be the market questions, Anne-Marie.
That's the thing. Reading the tea leaves, it felt like tariffs were not front and center, even though he talked about tariffs being, his most beautiful word in the dictionary, and the fact that he said day one, the walls will be going up. Does this tell you that this is a Donald Trump that wants to negotiate when it comes to trade realignment?
So there's a couple things. When I've talked to the Trump folks, they've said just because it didn't happen day one doesn't mean it's not a really, really important priority. And I also think what is happening here is there's a debate that's going on between Team Trade, who wants to be as aggressive as possible, the Stephen Millers, the Peter Navarros of the world, Jamison Greer, the U.S. Trade Representative, and Team Treasury or Team Econ, who are saying, look, there are opportunities to unleash all of these amazing things for the United States economy, and tariffs are part of it, but let's do it in an order that does not negatively impact the stock market and negatively impact the American people.
So we had a barrage of executive orders. Did any of them surprise you?
I thought the most interesting thing that I read last night was the creation of the Department of Government Efficiency, DOGE, taking over another agency within the executive office of the president. And it was an agency that was created by Barack Obama, the U.S. Department of Digital Services, after the failed launch of healthcare.gov. Why that's important is that is an agency with staff, with a budget. President Biden requested $35 billion for that agency in his FY25 budget. So come March 14th, when we have to extend out government funding, Republicans can immediately plus up that budget. And Elon Musk is going to have a staff to work with, a budget to work with, in a directive. increase the IT capabilities of all government agencies. And so there was a big sell-off when DOGE was announced that we'd have big cuts to government contracts. I think this is a big plus up to government contracts.
So it sounds like DOGE is actually going to potentially, at least for the moment, cost some money. We have congressional Republican leaders going over to the White House today. Speaker Johnson, John Thune, the Senate Majority Leader, are going to have to work with the president to try to enact his agenda. How do they get these tax cuts done? Because that's where there's going to be the biggest fight on Capitol Hill.
Yeah, so I think we're still debating in D.C., is it going to be one big, beautiful bill? Is it going to be two bills? I don't really care because I think that the base case to me is the tax cuts get extended. One of the conversations that's happening right now in D.C. is, do they actually become permanent through a trick of kind of which score you use? That's not priced into the market. And I think in addition to tax cuts, we're going to have an immigration provision, an energy provision, a defense provision that get added on. I think that's what gets worked out today at the White House.
Go back to that scoring and that you say that is not priced in. What do you mean by that? Meaning that they don't go and try to extend the tax cuts for 3 years or 5 years to make sure that it doesn't look like it costs as much to the federal deficit. They're actually going to say these are permanent, TCJA forever?
Well, there is a choice you have when you're choosing your score, and this gets a little bit wonky, but you could say, I'd like to get a score that extends out current law, and the law expires, so you have to account for the change of the law, and the 10-year score of that is north of $4 trillion before you add in other provisions. If you ask for a score that extends out current policy, you're actually not changing policy, so anything that is the law today comes back as a zero. And under the budget rules, if you have a $0 score in years 11 through 20, all of a sudden it's permanent. That's how they made the tax cuts on corporations permanent in 2017. That is how they're thinking about possibly making it permanent here in 2025.
So basically, Tax Cuts and Jobs Act becomes the base case.
Yeah, they do it as a baseline.
Wow. So, OK, let's stick with Congress for a moment. The majority, though, is so slim. And before they even talk about one or two beautiful bills, or maybe smaller beautiful bills, they have to get through spending, 2025 spending. The government will run out of money in early March, and they have to raise the debt limit. What do you view as the timeline for all of this to get done?
So I would also add to that a lot of disaster aid, which is actually something that brings people to the table. When we were debating the CR...
California, East Coast, the border.
Yeah, in December, we almost added in the debt limit, but there was no time. It really wasn't prepared. Come March 14th, when the next deadline is here, I could see the debt limit getting addressed there on a bipartisan basis. If it's not addressed there, we probably go out to the X date come midsummer, and that's where it gets messy. But if we get it done in March, that really does free up Republicans to focus on other things, and I think that's the desire. Because there is a need to extend the debt limit, a need for that disaster relief, to keep the government funding, and a time to move on to everything else, this gets done. Is there always drama? This is Washington, D.C., but this is not going to be a government shutdown.
Washington, D.C., and Donald Trump is back. So, Jonathan, Lisa, there is going to be a lot of drama. Our thanks to Ed Mills of Raymond James, walking us through some of the nuances of what President Trump will call the golden age of America.
Anne-Marie, thank you. Appreciate it. Might be a little bit too early for nuance. Who knows what we're going to get. On the tax front, I'm pleased you both talked about it just a little bit, because that's a much more complex issue. Much harder to get a lot of people in Washington to agree on what you should do on that front. How many Republicans are there in the House that believe they're king at the moment and going to try and push their own agenda through Congress and ultimately put a bill for the president to sign? Who knows when? April, May, June, maybe longer.
Yeah, and to Ken Rogoff's point, the things that Donald Trump was proposing in 2017, all stimulative for the economy. But rolling back SALT, unclear. And that, I think, is on the table.
It's the infighting within the Republican Party that hasn't got started just yet and may get started pretty soon. Up next on the programme, we'll catch up with the ByteDance investor, Mitchell Green of Lead Edge Capital, as President Trump gives TikTok more time to find a buyer. Live from Davos, Switzerland, for our audience worldwide at the World Economic Forum. Let's start with the equity market. Equity futures right now on the S&P adding a little bit of weight to last week's rally. Equity futures on the S&P 500 up by 0.33%, call it 0.4% higher. Similar move on the Nasdaq 100 up by 0.5. Last week, big week of gains for the S&P, the best weekly gain we've seen since early November. CPI came in softer, so did PPI. Governor Waller of the Federal Reserve was very dovish. That encouraged the equity bulls going into the weekend, maybe discouraging them on the margin. The volatility of the last 24 hours, Lisa, just 24 hours of President Trump and already whipsawed in foreign exchange.
Yeah, volatility in foreign exchange, to your point. This really is about the dollar, and whether the dollar is stronger, that means tariffs coming on, or whether it's weaker, meaning maybe tariffs are postponed. You're going to get dueling headlines depending on the hour, and this is how it's going right now. Not necessarily derailing the rally that we're seeing, though, in most asset classes.
I know people on programs like these like to say things with conviction, high confidence, so you trust them. I think we have to get used to just saying we don't know. Like, we really, really don't know what the next 4 years is going to look like, and particularly the next week when it comes to things like trade. With a few hours to go until the opening bell, one thing we do know is that Manus Cranny can get you your morning movers, and he joins us now. Good morning, Manus.
Jonathan, good morning. One of the laggards of this market is Apple. Their sales in the last quarter of last year in China on the iPhone dropped by 18%. That took their overall iPhone sales down by 5% in the back quarter. This is about relinquishing dominance, relinquishing the real delta in this trade, which is China. If we have more tariffs, what position will the iPhone play in that? Will they get a carve out? Who are you relinquishing dominance to? To Huawei. Huawei sales up 15.5% in the back quarter. Jefferies downgraded the stock on price target to $200. JP Morgan downgraded the price target to 260 from 265, but they keep it as an overweight. The scribes are out. They're just tepid at the moment. Intel. Takeover tantrum on Friday, stock up 9%. What's driving it this morning? You can throw anything at this wall. But the worst case scenario is that the Trump tariff salvo has not been launched at China. How's the foundry business doing? Who is in the back row behind Trump? Bezos, Cook, Pichai from Alphabet, along with Zuckerberg. But the CEO of Intel was not there in the background. 3M. Everything under the sun this company does, consumer, energy, manufacturing, transport, it's sort of almost the personification of the old GE, but a little bit tighter and better run, some would say, up 3.8%. The margins miss, but it is about Bill Brown turning this company around, and he's already begun to talk about tariffs. You got it. They export $4 billion worth of product. They import $1.7 billion. This is about dexterity within their own production and supply chain as a response mechanism to whatever tariffs are brought to bear in the United States of America against allies and foes. Jonathan.
Manus Cranny, appreciate that, sir. Need to turn to TikTok. The TikTok tantrum didn't last too long over the weekend. It was down, then it was back up. Anne-Marie joins us now from Washington, D.C. to explain just what happens next. AMH, has the president indicated what he's going to do and how much longer we have to wait until we get some kind of resolution?
Well, Trump last night was able to give TikTok this lifeline. In the executive order, though, it talked about a 75-day reprieve. Now, there's a lot of concern that actually does this make sense and act accordance with the law? Because under the law, the only way you would have this reprieve is if actually ByteDance was making significant progress to work with a buyer. What President Trump was talking about last night, though, is that he wants to make sure when he says TikTok stays 50% owned by America. He said everyone who's rich is calling him. Didn't give out any names, but my mind immediately went to someone like Jeff Yass, a big Republican donor, has a massive investment in the social media company, or someone maybe like Elon Musk or Mark Zuckerberg or Kevin O'Leary that would want to buy and get a part of this deal. Take a listen of how President Trump described what he sees for TikTok and its future.
I think the U.S. should be entitled to get half of TikTok. And congratulations, TikTok has a good partner. And that would be worth, could be $500 billion or something. It's crazy. The numbers are crazy. But it's worthless if the president doesn't sign, then it's worthless. There's so many different products made in China, and nobody ever complained about it. The only one they complain about is TikTok. And TikTok is largely young people. I guess I have a warm spot for TikTok that I didn't have originally.
That's for sure. He has a warm spot now. He recently was talking about how he wants to, quote, save this sucker because it helped him really connect with younger voters ahead of the election. Of course, at the same time, there's a lot of hawks surrounding President Trump, like National Security Advisor Mike Waltz, like the new Secretary of State, who had this bipartisan support last night, Marco Rubio, who are hawks when it comes to TikTok. And now what they say is potentially they have no problem with TikTok remaining a social media app as long as it is divested and doesn't have the control of the Chinese Communist Party.
The mood has changed on this topic a lot, back and forth over the last few years, that's for sure. Anne-Marie, appreciate it. We've got the perfect guest to discuss this topic now. Joining us now is Mitchell Green. I'm pleased to say the founder and managing partner of Lead Edge Capital. He is also an investor in TikTok's parent company, ByteDance. Mitchell, it's good to see you. Thanks for dropping by.
John, Lisa, thanks. I'm not sure I'm perfect, but I can have an opinion.
The perfect guest for us to have this conversation right now. I'm not going to ask your opinion on what you think will happen just yet. We'll get there. I'd like to know from your perspective what you'd like to see happen, what you would actually like to see happen here over the next few months.
I think what we need to see happen. So, stepping back, ByteDance has built a company that is a Chinese business that is truly global. And I think a lot of people fail to realize that, to understand the importance it is of like national pride to the Chinese. So the Chinese have always wanted to build a company that is, the Nike is sold in 150 countries around the world. You can buy John Deere tractors in probably 75 countries around the world. China has never had that. Alibaba wasn't that. Tencent's not that. I mean, Spotify is that for Sweden. I think for us to just assume that the Chinese government is just going to roll over and let Americans own half, 50, 75% of one of their crown jewels, I think is a difficult thing. It appears, I can't claim that I'm friends with Xi, and I can't claim that I'm friends with Trump. If I was, I probably wouldn't be sitting here right now. It's a game of political hot potato. Obviously, as existing investors in the company, we want to see some resolution worked out. I think what happens in the U.S. needs to be worked out before the global company can IPO at some point in some given time. We shall see what happens. I would tell you 6 months ago, I probably thought they were just going to pull out and it would be done, and the Chinese government was never going to let them do it. You might see a deal where now they spin it in some minority stake. Now, I don't think some billionaires in the U.S. Get to go buy the business for cheap. I think it's going to be way more complicated than that.
You understand where some of these questions come from when we hear language like China won't let them, the Chinese government won't allow them to, and at the same time, apparently it's not a national asset. Do you understand the complication there?
Yes,
that a lot of people struggle to get their hands around? Because as an investor, what I would struggle with is a company I'm invested in putting national pride before me as a shareholder. Can I ask you, are you disappointed that they didn't look to find a buyer?
Not yet. Question.
Sure.
What do you think the U.S. government would say if China told Apple, I'm sorry, you don't get to sell Apple, you don't get to sell...
They've said that to Meta.
They said it to Meta.
Meta's not there.
They're not there. Apple still is. And lots of other Microsoft still is. So it will be fast. I think it is good. It is bad for both countries if we do not work it out. So they need to figure it out. And you might see a minority type deal get done. Look, a spin for existing investors, a spin would be absolutely incredible.
That would be the dream.
It would be like the dream. Oh my gosh. For like the price that we've bought it over the last year you'd effectively be getting the thing for free. I mean, if you ask yourself, what would a strategic, if the government would allow them, what would a strategic like Amazon or Microsoft or Google or Facebook pay to own TikTok America? Like it's 10% of the market cap. It's a giant number just for the optionality. I do think it's important for the audience to understand the following.
Sure.
It's just not that much of their overall business. 90+% of ByteDance business, less than 10% of the business of TikTok is in America.
So are you basically saying that if people sell ByteDance shares on the potential of some sort of regulation or spin-off or some sort of question about whether TikTok can operate in the U.S., any selling you're buying?
We have been buying. Put it this way, our base case is it's shut down in the U.S. Our base case that we run, buying stock at the price you can buy stock at today, is the thing gets shut down. If for some reason it doesn't get shut down and it stays in Holdco or it gets spin off, that's like a huge win for us.
So what do you think should be done given the fact that you are an investor and you're an investor in social media companies and you actually have pretty strong feelings about the regulatory regime around social media companies in the United States?
It should be regulated, 100%. Here's why. In China, ByteDance is a highly regulated item. Now, it's way even more regulated than it would be in the United States. But there is a reason on Bloomberg TV or CNBC or Fox or any other cable television channel, we can't sit and swear on television and have like inappropriate content. What is absolutely incredible and kind of insane to me is that this same regulation doesn't exist for social media. I think it's coming. It should happen faster. I hope I speak for huge millions of parents in America that this is like social media in a weird way is like the demise of Western society. But funny enough, ByteDance, actually 90+% of their revenues come from a region where it is highly regulated.
Okay, but then how is an investor, and this is a really important question for a lot of people here at Davos, where they're talking about rah, we can't wait for our businesses to explode. And, 4 or 5 years ago, they were talking about the demise of Western civilization with the incoming of Donald Trump, and the tone has changed. How do you as an investor strip out should from this is going to make money and we want to invest here, and ultimately you benefit if it does remain in the U.S. unregulated?
We of course, that doesn't mean I can't, by being an investor in the company, try to talk to people in the government about ways to potentially regulate it. You want to regulate social media in the U.S., call Mark Zuckerberg and call Evan Spiegel, who run the biggest companies. And I think it's coming. I don't know if it's reached a boiling point. There's been a lot of research written by there's authors speaking here, like the Anxious Generation and some of these things that have written a lot of very good research on it's not just social media, by the way. It's all technologies and teenagers. And I think there are things in China, some of the policies in China as it relates to regulation of some content, some of that would be good to have in America. Not all of it, but some of it.
If it does get banned, how are you thinking about what replaces it and the investment opportunities that might exist for you now? Would you rethink making that investment if you knew we'd be where we are today? We have bought shares in ByteDance in the last year, and we have in our financial models and our memos, our base case is shut down and banned. Where does it go? Well, I think you just saw that Facebook is trying to release new products to compete. Snapchat will have it. Here's a very interesting thing. In India, when it was banned a handful of years ago, there's been no competitor that has really emerged that has taken over.
How much do you look at who is at the inauguration? Which executive is getting closest to Donald Trump to decide which company to invest in?
Oh, now you get to see Dana White join the board of Facebook. But by the way, as you were talking about the Trump administration, and we're not political experts at all. Of course. At all, but what I've realized is if you do the opposite of the crowd, like the crowd is usually wrong. If you ask 10 of the smartest hedge fund managers, like where is the stock market going? When one says one and 9 says the other, it tends to go where the one goes. So I think we have to balance like how excited we are for any administration coming in one way or another. I'm sure it's going to be a fun-filled 4 years, and it's good for Bloomberg and New York Times and everybody else. And so I assure you, over the next 4 years, you'll have lots to talk about.
It's been a fun 24 hours.
24 hours.
Fun 8 minutes as well with you, sir. Thanks for your time. I appreciate it.
Thanks so much.
Let's do it again soon. Mitchell Green there of Lead Edge Capital. Let's take the opportunity to get you an update on stories elsewhere as well with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. President Donald Trump has begun the process of withdrawing from the U.S. from the Paris Climate Agreement, rather. The withdrawal will take a year to go into effect. It does signal Trump's commitment to rapidly overhauling U.S. energy and climate policy. The move, not entirely unexpected. Trump pulled the U.S. from the pact during his first term, but the world's second biggest polluter leaving the accord already has shaken global climate diplomacy. Vivek Ramaswamy has reportedly stepped down from co-leading President Donald Trump's Department of Government Efficiency with Elon Musk. Ramaswamy is instead planning to be running for Ohio governor, according to reports. Current Ohio Governor Mike DeWine selected his lieutenant governor to replace VP J.D. Vance's seat in the Senate. That opened up the possibility for Ramaswamy to seek the governor's mansion in 2026. A union representing thousands of Costco employees has voted to authorize a strike ahead of a January 31st contract deadline. Costco Teamsters says 85% of their 18,000 nationwide members voted to approve the strike, which could impact daily operations at the big box retailer. The union says the company has failed to present a fair contract that, quote, reflects the company's record-breaking profits. And that's your Bloomberg Brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, investing in economic growth.
I do think we are in a period where rates do look attractive versus where equities are. And we're in a period right now where we're still the place of economic growth, but it is a warning sign for the administration about how much they can push.
Live from Davos, Switzerland. Welcome back to the program. Let's check out the equity market to kick things off after a long weekend. Said this a little bit earlier. I'm not sure how many of you actually had a long weekend. If you're in this market, you're probably glued to things happening elsewhere. Equity futures on the S&P up by 1/3%. Bonds are bid, yields are lower. We're down 5 basis points. But it's these moves in foreign exchange, the weakness in the Mexican peso, dollar mex up, the weakness in the loonie out of Canada, dollar CAD up. We're seeing it repeatedly, Lisa, just whipsawed through the last 24 hours.
Yeah, and this was expected. This is my real question. Why are people trading on things that are so flimsy? Because traders got to trade. At what point is this offering people an opportunity to fade each of these moves as we wait for another headline that's going to say the exact opposite in a couple hours' time?
Joining us now to have that conversation, I'm very pleased to say, so we don't have to talk about it, he does. Joining us now is Steve Tananbaum, the founder of GoldenTree Asset Management. Steve, it's good to see you, sir.
Great. John, Lisa, great to be back.
Thank you for being with us. I was listening to some of your comments immediately after the election, where you said it might be more bark than bite, that maybe people are getting over their skis just a touch. Where do you think we are now, and what are you expecting?
So listen, it's been a lot of enthusiasm, a lot of hope, and it's great. And prospects look like they're accelerating, improving, and valuations suggest that. So my guess is it's not going to be a one-way train, a one-way trip, and that we're going to likely to get a pause. What does it mean 6 months to a year from now? If you look at the Reagan analogy, there was a lot of hope built up. The first year was tougher, but then it built on that, and it ended up being a very good experience. And there's no reason to think you can't have different environment but similar results over time.
Is confidence sufficient to generate economic activity? Because confidence feels sky high, speaking to American executives, and you see that in the sentiment surveys over the last few months as well. Do you see that translating right now into superior economic activity?
Absolutely. There's a lot of excitement, and there's a can-do attitude, and people feel good.
So Davos always tends to be wrong. People get together and they have this conviction, and then the exact opposite usually happens over the remainder of the year. I just keep that in mind at a time where the conviction seems to be American exceptionalism, growth is going to go gangbusters, and there's this huge fly in the ointment, which is the debt market and what rates are saying. How much does that worry you?
Great question, because will we get the cuts that the market's hoping? And a lot of the valuations are assuming that rates have a downward bias. And if they don't and have an upward or a flat bias, will that hurt valuations? If you look at nominal growth rates, which we think will be about 5%, so nominal is inflation plus real. And if real is a higher percentage than inflation in that 5% number, that's a good thing. And there'll be room to cut. But if it's about the same, or there's more inflation in that nominal number as a percentage of the total, then it's going to be a pause, and that's not going to be good for the markets.
Based on that, are credit markets, in particular high yield markets, priced to perfection, sort of leveraged to both the growth and the idea of potential cuts?
You're leading the witness, by the way.
But Lisa does that a lot.
Carry on.
Yes.
Please, answer.
As long as the market's constructive about growth, valuations make sense. If there's volatility on, is inflation accelerating? Is there a concern that you're not going to have cuts? You may even have an interest rate spike or pause, then that's going to be different. Some of the outliers, like the tariff conversation, I'm less concerned about today.
How How much are you actually starting to look outside the U.S. because of valuation story? I mean, this is something we keep hearing about, going to Europe.
Sure.
We're here, but also investing.
So one of the interesting things on Europe are the real rates are quite low compared to the U.S. So if you look at economies, for instance, like Germany, you could say, well, there's low debt to GDP, and their real rates are called, the 20-year rates are under 1. So that you could kind of make a case for that. I don't think a very good case. But when you look for something like France, where it seems like they have worse flexibility, they're might be spending more on defense, less entitlements, less growth. And those real rates, or the 20-year rates, are in the mid-1s to low 1s, and the U.S. are in the mid-2s. It doesn't seem right. So the real rates in Europe seem high. I do feel as if, and you look at the Mario Draghi report on competitiveness, there are solutions. There is self-help if they choose to do it.
How much needs to go right to generate bigger returns out of Europe? Because expectations into 25 are exceptionally low.
Yeah.
And we've seen one earnings report, I can think of Richemont in the last week, came out with a decent earnings report, stock up 10, 15, 20%, just like that.
John, it feels that way. So you look at, for instance, I was talking about Draghi's report. He singled out telecom, where they used to very much encourage competition. So retail prices low, but as a result, you couldn't reinvest in the properties, in the systems. And as a result, the investments the companies sell for very low multiples. You take something like a Vodafone, if all of a sudden consolidation occurs, which occurred, and that they allowed the investment on their systems to have appropriate returns, those valuations could be up 50 to 100%. So I could see it. Look at something like Germany in Vodafone. If that's stabilized and you believe that there is a good investment, that could be really very attractive.
Before we let you go, last year you sold your crypto business. This year, crypto's gone crazy.
Yes.
Do you regret it?
You know what? Not at all. And because it's in a better home. I mean, we've done some things that have been crypto related, and the firm Republic, who we sold it to, was just a more appropriate home for it. But and I think it's an interesting space. I'm not so sure if the valuations justify the fundamentals today, but the fundamentals are very strong.
How do you value these companies? How do you value these things? What are the valuations of them? I've heard from traditional investors who just say, I can't have tolerance to invest in something if I don't know why it goes up or down from week to week.
I try and focus on what I can analyze, and there's enough of that than to worry about what I can't. And, there's very much, it's a concept. And you could have said that about the internet in 2000.
It's true.
And, it's a concept, and some will be realized and some won't be.
Steve, appreciate your time. It's always good to hear from you. Super smart. Steve Tananbaum there of GoldenTree Asset Management. The thoughts, Lisa, on Europe, I think, are really, really important. Slightly contrarian because everyone is so downbeat on Europe coming into the year, particularly on the economy. To transform the lives of Europeans, you need big changes. To generate excess returns in European assets, only a little needs to go right. Just a little bit here and there, some incremental change, and you can see some big changes, some big moves in financial markets.
There's a lot of capital sloshing around that's getting very nervous about the elevated valuations and the price to perfection narrative in the United States. To the extent that the European Union could benefit from that, a lot of people are taking notice.
Up next on the programme, the third hour of Bloomberg Surveillance just around the corner. We'll catch up with the former NEC director, Gary Cohn, Andrew Forrest of Fortescue, David Rubenstein of the Carlyle Group, and HP Enterprise CEO Antonio Neri. All of that coming up from Davos, Switzerland at the World Economic Forum. You're watching Bloomberg TV.
The golden age of America begins right now. Today, I will sign a series of historic executive orders. With these actions, we will begin the complete restoration of America and the revolution of common sense. I will declare a national emergency at our southern border. The inflation crisis was caused by massive overspending and escalating energy prices, and that is why today I will also declare a national energy emergency. My proudest legacy will be that of a peacemaker and unifier.
This is Bloomberg Surveillance, live from Davos, with Jonathan Ferro and Lisa Abramowitz.
The new president promising a golden age for the United States of America. We said this a little bit earlier on the program. What we've had so far in 24 hours, a golden age of volatility in foreign exchange, whipsawed, Lisa, by trade headlines.
Will they or won't they with tariffs? That has been the story for so many people in the foreign exchange market. For the business community, it is unabashedly, they will, and they will make it good for us, and we will come. And that has been the tone here in Davos, listening and, as you've pointed out, responding to everything we're hearing down in D.C.
The banks are fired up. Citi started the program with us a little bit earlier this morning. Really looking forward to the year ahead. M&A and the United States of America and what this economy can bring. We heard from JP Morgan sitting down with Jemana Besetchi earlier on this morning at the World Economic Forum. Basically, Lisa saying the same thing. It's go time in the United States. I'm not sure how the rest of the world feels about this. I don't know if Europe and China can feel confident about the future because they were spared in the last 24 hours. I think maybe we're getting a little bit too excited about what people were talking about yesterday, the incoming president taking a measured approach on trade. That lasted about 6 hours.
Well, right now, we have to temper all incredible ebullience with the idea that usually the zeitgeist in Davos tends to maybe be proven to be less than correct or not necessarily correct, at least 50% of the time. There's a real point here, though, about how much this translates to the rest of the world with U.S. companies, as we were talking to with the Citi head of banking, looking outside of the U.S. to do acquisitions because of the strong dollar, or investors seeing price to perfection, shifting them into other places. In other words, is the dynamism going to leave the U.S. into other pastures for 2025?
Anne-Marie's in the nation's capital. She skipped this event for good reason, the inauguration yesterday. Anne-Marie, there's a new date on the calendar circled. It's the start of February, February 1, and what might change for global trade?
February 1, potentially, is that when we can start to see some of these tariffs that Donald Trump has been talking about for months, actually years, take shape. But notably yesterday, when he was talking to reporters about what he's looking at, he talked about Mexico and Canada. And I think this is really twofold. One, we do know that they want a little bit more of a study when it comes to specifically what they're going to do with China. He talked about the fact that he was invited to China. And of course, he wants to get on a phone or have a meeting with Xi Jinping. But when it comes to Canada and Mexico, this is part of the broader approach to focusing on immigration and also fentanyl. He specifically spoke about fentanyl coming into the country yesterday. So potentially we could see tariffs as high as 25% going towards Canada and Mexico, or this is a negotiating tool. Because remember what happens next year, 2026, USMCA, that trifecta trade deal between Mexico, Canada, and the United States is up for renegotiation. And already we see some of these countries starting to plan for what is to come down the pipe from this Trump administration. Look to what is going on in Mexico this morning. They came out with a decree wanting companies to come back, what they're calling Plan Mexico, have incentives to come back and produce in Mexico. So Mexico itself could be less reliant on Chinese goods. What we do know irks the Trump administration, a bit of a leaky border when it comes to some of the manufacturing goods that China has in Mexico that come into the United States.
Anne-Marie, appreciate the update. Joining us here at the World Economic Forum, I'm pleased to say Gary Cohn, the IBM Vice Chairman and former National Economic Council Director under Donald Trump. Gary's seen it all. Gary, it's good to see you.
Great to be here. Thanks for having me.
We mentioned this the last time we caught up in New York, how different things might be this time around. What are you hearing here in Davos, Switzerland? How different are things this time around compared to years gone by?
You know, I start out with the premise Lisa's making. I always take Davos with a grain of salt, because, you know, you have lots of different opinions here. And always the start of a new year, everyone likes to be excited. Everyone likes to be balled up. We obviously went through an inauguration, a change of power in the United States yesterday. We know that's fairly positive for business. On the fundamental level, it's positive for business. It's a pro-business. It's a smart regulatory environment. So everyone's thinking that's very good for business. But I think we're going to ultimately have to see what the year brings, because there's still more unknowns than knowns in the equation at this point.
When you were last in the administration, the focus was on taxes first and has spent the best part of the year trying to work out that tax bill. The following year, things shifted towards trade. There's a sense this time around that maybe we can do everything all at once. How difficult is it to do everything all at once?
Look, I'm not in Washington right now, so I don't know. I can't speak for them. But look, doing taxes by itself is going to be quite difficult. There are a lot of different constituencies in Washington when it comes to doing taxes. And look, there are small margins of victories, right? Especially in the House. You've got 2 or 3, today it might even be 1 or 2 seat majority in the House. And within the House, you've got certain members that want certain things to be able to vote for a tax bill. You've got certain people that are deficit hawks, so they do not want to see the deficit go up. You've got other members that want to bring back as much of the state and local tax deduction, the SALT, as we always call it, the SALT deduction. You've got other members that want to just extend everything in the Trump's tax cuts. Then you've got those that want to not only extend what's there, add all of the additional things that were talked about on the campaign trail. All of those things have a price tag associated with them. So it's $4 trillion, $5 trillion, $6 trillion. And you try and balance those with the people that don't want to have a deficit. And ultimately, something has to be worked out. And remember, the only thing that really has to change, because it expires at the end of the year, is the personal side of the equation. That doesn't mean they won't touch the corporate side of the equation, because to make this all work, they're going to have to balance it. It's a balancing act, and there's numbers. So you're going to need revenue from certain places to be able to give it in other places.
It's a balancing act for Congress, and each congressional member has its own power just simply because of the thin margins. It is a one-man show, though, when it comes to tariffs. And are you surprised that we didn't see more aggressive tariffs implemented or at least even announced from the get-go, other than what we heard about from Mexico and Canada?
No, I'm not surprised. I think that even when I was there 8 years ago, there was always a heavy debate on tariffs, on the positives and the negatives of tariffs, on the intended consequences, the unintended consequences. Look, it's day one of a 4-year administration. You don't have to put tariffs on day one. I'm sure there's an enormous amount of debate going on in the White House today, as there was in the transition, on what to do with tariffs, where to put tariffs, where can tariffs be helpful, where can tariffs be hurtful. There are places, I'm sure, where there's pretty universal agreement that we should tariff. There's other places where there's probably divided opinion, and there's places where people think there should not be tariffs.
So we're here in Davos where everyone's incredibly excited about all the good and not really considering the potential inflationary component of this, the potential rate rise that could accompany this, or the potential slowdown from an increase in the price of goods at a time when spending power has been coming down. Are you trying to tell corporate executives who you meet with or others, maybe temper your enthusiasm?
No, I'm not trying to tell corporate executives anything. I think every one of us is eyes wide open. Everyone has a fairly good view of what's going on in Washington. Look, the one thing about the Trump administration is they're very transparent. The administration is very transparent. They've had enormous access. The corporate community has access. The corporate community has been involved. The Trump administration has wanted to hear from corporate community. So no one needs to tell the corporate community to slow down. I think what people are starting to understand is what are the intended, what are the unintended consequences. As you talked about, we've seen a higher rate environment. We're talking about an environment where we may not get cuts this year. We're talking about a steeper and steeper yield curve. I think the realization that the COVID financings that were 5-year financings come due. There's a big maturity wall coming up. There's also a lot of deals in the pipeline. If you look back at the vintage years of sort of 2010 on in the venture world, the private equity world, there's been very little to no liquidity out of 2010 vintages on. There's a lot of investors, especially pensions and endowments, that are looking for a return of capital from those vintage years. There's a lot of pressure in the system to do transactions and get deals done. We all feel that. We all know that. That will be great if we can get it all done. But I think there's a realism that not all of this can get done at the same time, and we'll have to see what the market can bear. And we have all of this at the exact same time when we have very tight credit spreads and very high multiples in the market.
You've said it repeatedly. Coming into this year, there's a lot of paper that needs to be moved. There was a moment in the hearing with Scott Bessent, the incoming Treasury Secretary, where he was asked about scrapping the debt ceiling, the debt limit. And he said something, and Senator Warren didn't really let him speak. But what ultimately he was getting at was that he wanted to survey market participants. And what I sensed about where he was going was that he wanted to find out how market participants would respond to that headline. Now, you've been in both office, in the administration, and you know the business, financial markets, in your time at Goldman Sachs. What would you be telling Scott Bessent about that, about how that headline would be absorbed in financial markets? And are you concerned that we could get some pushback to some of these plans?
Well, I think you will get some pushback to some of these plans. You know, the market is getting to a point now where they're telling you we are more concerned about the debt and the deficit today than we have been in a while. And I think there's a few factors there. The debt and deficit continues to get bigger, but we're also getting closer and closer to that Social Security sort of tipping point. You know, and they work together. We all know that the Social Security Trust Fund will be unable to fund itself in a matter of years. So it's 5, 6, 7, 4, you know, so somewhere in there. And I think we're all confident that no one's going to cut Social Security payments. There's no member of Congress that is going to vote to cut Social Security payments, nor should they. So not only do you take the pre-existing debt that we have, the debt that we're going to continue to build by running this government, you're going to have a new source of additional debt called Social Security that you're going to have to fund. So you start putting all those things together and you look at what the government's going to need to borrow in the near future, and it's a fairly large number, and the rollovers, the quarterly rollovers, are going to start getting quite staggering. Add to that the prior administration did not really elongate the maturities on the debt. They were using a very short-dated maturity system, which I didn't understand when we had low rates. When you have low rates, you want to elongate your debt. We're going to have to deal with the problem that we never really put duration into the pre-existing debt. So we've got to roll the duration of the pre-existing debt out. We got to add to it the new debt we're going to create, and we got to be prepared for Social Security.
Do you think we can term out the debt? Just to unpack one piece of that. If we termed out the debt right now, and you're fantastic at this, we've talked about it before, front end of the curve at the moment is priced around Fed funds on 2s. The curve is, 40, 50 basis points steep, maybe 40, something like that, the last time I checked. Historically, that's not that much. I mean, I don't think there's any real sign that we're freaking out about the fiscal deficit yet. That's before you even do all of these things you've talked about.
We're not. Look, I think it's a good opportunity to term out debt. We've got as you said, a 40-point inverted yield curve. Historically, we've got a positively shaped yield curve. You know, we still need to continue to elongate our maturities in the United States.
You think we have the space to do that right now? Because I think it's about 40 basis points steeper, 2s versus 10s. Do you think we have the space to do it still?
Yeah, it's steep.
Yeah,
it's steep. You're right. We do need to do it at 40 basis points. I still think it's the right place to go.
Your message to the people that didn't live a steep yield curve and think that right now at the moment, like, this might be it. What's your message to them? My message is go back and look at history. You know, if you go back and look at history, the 100-year, 10-year rate average in the United States is over 4%. And if you look at the steepness of the yield curve over the 100 years, we've always had 100, 150 basis points of steepness in the curve. If you look at Fed funds out. So we are still at a relatively flat curve. Gary, appreciate your time. Always sharp. It's good to catch up. Thank you, sir. Gary Cohn there, the former National Economic Council Director and, of course, formerly of Goldman Sachs as well. Let's take the opportunity to get you some stories from elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A ceasefire in the Gaza war has entered its third day. Hamas released 3 hostages on Sunday. Israel released 90 Palestinian prisoners on Monday. Hundreds of aid trucks have also been cleared to enter the area. A Qatar Foreign Ministry spokesman said this morning that Qatar is working on the second phase of the ceasefire and aims to complete it before the end of the truce deadline. A new fact sheet from the Trump administration has called for federal agencies to address currency manipulation. The fact sheet has yet to be made public, but a copy seen by Bloomberg details the president's desire to address unfair trade. Japan, China, Germany, and Singapore are all already on the Treasury's monitoring list for currency practices. A cold blast gripping the southern U.S., threatening to bring record snowfall to New Orleans and Houston. Extreme cold warnings are in effect from North Dakota to West Texas, with frigid temperatures causing concern about natural gas output and the electrical grid. The Texas grid has a weather watch in place with projections showing demand may test the winter record of 78.3 gigawatts set last January. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the program, a focus on global growth.
With the valuations currently in the United States, you know, with that comes responsibility, because companies and boards have to say, okay, for this valuation, I've got to show growth. It's either got to come organically or through acquisitions.
Live from Davos, Switzerland, at the World Economic Forum. It is day one for Bloomberg Surveillance, and that's all that matters, even though technically I think it's day two for the World Economic Forum. And that doesn't matter. It is day two for the President of the United States, Donald Trump, and he's already shaken up financial markets worldwide.
Good save.
Thank you. Equity futures right now on the S&P 500 positive here by 0.4%. In the bond market, yields are lower. We're down 5 basis points on a 10-year to 457.43. The euro negative by 0.5%, rather negative against the dollar to 103.59. The weakness we're seeing beyond the euro, though, it's all about the Canadian currency, the Mexican peso, off the back of these trade headlines, Lisa, overnight.
Yeah, basically, how much do you start to see a weakening in the Mexican and Canadian governments or economies on the heels of a potential 25% tariff that Donald Trump is now talking about being implemented on February 1st? How do you decipher the signal from the noise, given that we're going to be hearing a lot of noise in the next couple of weeks?
And that was the challenge in the first term. It's going to be a big challenge in the second term as well. Under surveillance this morning, a focus on global growth.
With the valuations currently in the United States, with that comes responsibility, because companies and boards have to say, okay, for this valuation, I've got to show growth. It's either going to come organically or through acquisitions, because shareholders don't have patience. So the minute your growth is not forthcoming, they work with their feet. So guess what? I either have to grow organically or I have to go buy and build.
Just to build on that, so that was Vis from Citi. And the argument that he was making off the back of that valuation story is the amount of available credit some of these companies have to look abroad, particularly US companies, to look abroad with the support of a strong US dollar and to go on a shopping spree worldwide.
Yeah, well, if it's cheap to go on vacation in Europe, just imagine if you're a company and you want to go shopping. It's essentially a very similar dynamic.
Just very different in terms of what you and I spend on vacation.
Different in every other way.
Like $50 billion companies.
Yeah,
but other than that, it's really
theoretically
similar, Manus. Very similar. Let's get your morning calls. Here's Manus Cranny. Hey, Manus.
Hey, John. Good morning to you. Some stocks to focus in on, but it is Apple that really takes the headlines. First up, you've got Jefferies downgrading the stock to underperform. They expect upcoming results to miss the estimates due to the weak iPhone sales in that back quarter. Next up, Loop Capital downgrades Apple to a hold, pointing to a material reduction in the iPhone demand. Not looking good, is it? JP Morgan comes in with a final knife. The company's stock price to $260, saying the shares' loss of market share is likely to continue in China. Go Huawei.
Manus Cranny, thank you, sir. Appreciate it. Some of the morning calls this morning going into the opening bout, a little more than an hour away, 1 hour and 10 minutes. Joining us now, Andrew Forrest, the executive chairman and founder of Fortescue. Andrew, it's good to see you.
Yeah,
Thanks for catching up with us.
Guys.
Thanks for dropping by. I want to talk about what's taken place in the lead up to this event and then get your thoughts on it. So there has been what many people are describing as a vibe shift. So at certain companies, they're rolling back DEI initiatives. Some people are looking away maybe from ESG, thinking less about net zero initiatives. You've got very strong thoughts on all of this. You don't think we should be pulling back. You think we should be going even further. Just describe your stance on those issues.
Very happily. I think net zero is really interesting, very hard to finance, very hard to build against. I don't see a lot of merit in drill, baby, drill. I see a lot of merit in build, baby, build. That's where we need to be going, and that means you have to have finance. Now, if you want to finance something, and I'm sure President Trump would agree with this, you've got to be able to measure it. So what you can measure, a financeable model, is simply stopping the burning of fossil fuels. Put all that money you save in the bank. Banks will lend against those savings. And there is a financial model to stop the burning of fossil fuel. Now, I know that doesn't go well with the current parlance coming out of Washington, D.C., but I don't care. I'm a global business person. I have to build projects. I have to raise capital. Real zero, simply stopping the burning of fossil fuel, say by 2040. You could call it woke, you could call it ESG. I don't care what it gets called.
You could call it unrealistic.
But we're doing. Well, you'd say that, but you're a commentator on a TV. Come and sit in my shoes, and we're doing it. We're going to drop 1 billion litres of diesel a year out of our supply chains this decade, and we're going to make money from that. So I wouldn't call it unrealistic unless you want to come and run the show.
It might be realistic for your firm, unrealistic for the planet, isn't it?
You know what is totally unrealistic? Thinking that we're going to save the climate. There's one emergency the president didn't declare, and that's the one you've just put your finger on, the climate emergency. What's unrealistic for the planet is that we keep on burning fossil fuel. We kind of pretend the climate doesn't exist. We kind of pretend that I'm not wearing a coat here. The last time I was here, the snow just smashed off the roof. This is a difference in climate we're seeing. And look, over 4 years, you probably won't see much, but your kids are going to see it and your grandkids are going to see it. And it's now time to move.
As someone who's not a talking head, who's actually running business, you actually ratcheted back your goal of producing 15 million tons of green hydrogen, partly because it was getting so expensive. How do you dovetail the idea of how expensive it is to finance some of these projects that can save the world, but that aren't realistic in the current financial environment?
Yeah, so look, only a short span of history. Oil was $1,600 relative dollars a barrel when it got going. Hydrogen is nothing like that expensive, but there is a new form of hydrogen which will come onto the marketplace, which will be a lot cheaper. We're not yet in a position where I want to talk about it publicly, but if people walk away from hydrogen completely, we're not walking away from producing it. Our customers walked away from saying they want to buy it by X or they want to buy it by Y. If I say to Germany or France or South Korea, do you want to not buy it at all? They say, oh, no, Andrew, hell no. No, we're there, baby, we're there, but just not tomorrow.
So there's been a lot of focus on Fortescue about the focus in iron ore, particularly on how leveraged that is to China. Have you thought about diversifying more into certain precious metals that are used in different green energy sources?
Yeah, no, that's a really great question. For us, you know, we all live a short time on Earth. We've got to make the biggest difference we can. And that is through using iron ore to become fully green. That's where my friend says I'm unrealistic. Just come on down, baby, to Western Australia. We'll show you realism. We'll show you these trucks running on no fossil fuel. But that said, the best thing we can do is stop using fossil fuel to make our iron ore. And that's step one to making green steel. So we're pointing to China that the smog you see over China, India, other nations is generated from the steel industry. Now, if they can bring in green metal, and add on their cake mix of nickel or lithium or whatever it is into that metal, those skies will go blue. And so we're introducing policies to any city in the world who wants it, blue skies, green cities, and that is simply buying green metal. So you do not have to burn coal. You do not have to burn iron ore. It's done for you by the solar, by the wind, and we just send in the metal, no carbon.
I feel like we've fallen out. Are we friends again?
We're buddies. We're buddies.
I'm just a journalist asking questions. I think a lot of people look at this shift and they say, OK, zero tailpipe emissions, but there are serious negative externalities involved in the production process for a lot of the automakers. I think from a national security perspective, people suggest this is making us more dependent on China. From a societal perspective, there are countries across Europe where consumers can't afford their energy bills, given this shift. There has been a real reality check for the likes of the Germans, who were dependent on cheap gas from the Russians and have found themselves in a situation where they're burning coal again. That's the realistic view of the last 12 months now, Lisa.
Yeah.
The last year.
Yeah, well, that's
the challenge.
The geopolitics mixed with some of the externalities and some of the lofty goals.
So we needed more time. I'm hitting a break, and I've got to go. TV commentator Jonathan Ferro with Andrew Forrest of Fortescue. I'm offended. I'm so offended.
Come on, Tigger. You didn't give me a chance to reply.
I'm so offended.
You did.
We got a break. We're going to break. We should do a longer show together. A podcast.
You didn't give me a chance.
Okay, where am I looking? I'm looking here.
The opening bell is about 60 minutes away after a long weekend of following the biggest weekly gain on the S&P 500, going all the way back to early November. Let's get you some movers. We can do that with Manus Cranny. Hey, Manus.
Jonathan, let's just expand a little bit on some of those morning calls around Apple. This is about questioning your dominance. Your dominance in China, where your sales fall by 18% in the back quarter. You're relinquishing dominance to Huawei. What is that about? That is about product proposition in terms of AI and in terms of handset. JP Morgan downgraded the price to $260, and they talk about a limited traction on AI. I'm going to say that again. Limited traction on AI. What are you, Lisa, and I prepared to pay for access to AI? Stock down 2%. Huawei just blows it away. Their sales up by 15.5% in the back quarter. Intel. They weren't in that big lineup behind Donald Trump, the president. You saw Zuckerberg, you saw Bezos, you saw Cook, you saw Pichai, but you didn't see the CEO of Intel. Is this a bid proposition? That's the question that you need to roll over in your mind. 3M, think about GE just in a modern context. Consumer, energy, manufacturing, transportation. The margins were lighter than the market had estimated, but Bill Brown is transforming this company with cost cuts, productivity, etc. And he's already talking about how will we handle Trump tariffs. They export $4 billion. They import $1.7 billion. So it's about the dexterity within the domestic supply chain and the ability to deliver to the home market, as well as adjusting the dial for those imports. Jonathan, Lisa, good morning.
Manus, appreciate it. And good morning to you. I think we're running with good morning for the week, even though technically it's the afternoon in Switzerland.
What about me? We? You think that that's really our collective decision?
We? I
Okay,
don't want to speak
actually,
to you.
hold on a second.
What would you like to go
Hold on a
with?
second. Why don't you say good morning and I say good afternoon?
Okay,
you could be
just
in,
confuse everyone.
Yeah, that's
okay,
correct.
all right, we can
Like
do
my
that.
son.
It's 1:30 in Switzerland. Good afternoon. Here's Anne-Marie in Washington, D.C., where I believe it's 8:31. Anne-Marie, good morning.
Yeah, it's good morning. It's definitely good morning because Washington, D.C. has pretty much become the center of the world. So let's stick with good morning for the rest of the week, guys. And it's going to be a busy one yet again today. Day 2 of Trump 2.0. What we're going to see is Republican congressional leaders making their way over to the White House. Really key here is going to the meetings President Trump has with Speaker of the House Mike Johnson, who has one of the slimmest majorities we've ever seen the Republicans have in the House. And then, of course, Senate Majority Leader John Thune. And what they're going to be discussing is really how are they going to enact Trump's agenda that we have been talking about for months. I would also note the World Economic Forum has now put a special address from President Trump on the schedule for Thursday, 5 p.m. your time, 11 o'clock here in Washington, D.C. I imagine that speech is going to sound like something like a grievance list from President Trump telling the world's global elite where they've made mistakes, whether or not that's in defense spending when it comes to Ukraine, whether or not that's places like Germany, and really they're reliant on Russian gas and oil, or maybe potentially trying to school them in some of the trade realignments we've seen, especially when it comes to China dumping on markets. And then finally on Friday, Trump will make his way to the other side of the coast, and he'll be touring Los Angeles, that is still dealing with these wildfires. Absolutely devastating what is going on in California.
It truly is, Anne-Marie, and that's certainly affecting people here who are talking about that. I want to go back, though, to the Thursday address, to people here at Davos. We've talked about the tension right now between people who chose to stay in Washington, D.C. versus come to Davos and look to make deals on the heels of some of the policies. Could you talk to the presence in Washington, D.C. of corporate America, how big it is, why it's there?
And some of the very special individuals potentially attended the inauguration and then got on private jets and went over to Davos, Switzerland, and are probably telling all their friends about what they've learned if they were in the rotunda yesterday. I mean, what was so fascinating yesterday is that you had tech CEOs with better seats than some members of Trump's own administration, incoming cabinet secretaries, and also members of Congress. So you could really see the balance of power has shifted, especially this time around for Trump. This has been more of a homecoming and a welcoming. Even President Biden said to him yesterday when he arrived at the White House before they made their way to Capitol Hill, welcome home. But when it comes to these tech executives, they want to make sure that they have the ear of the president. We saw this during the first round of Trump's administration, how important that personal relationship was for Tim Cook of Apple. When Donald Trump talked about, Tim Cook would call him and say, well, this is why potentially I need your help with something. This week, Donald Trump told a rally before he was inaugurated that he had a conversation with Tim Cook, and because of the election, he wants to invest more in the United States. I think you can look at this with a little bit of cynicism. Of course, these tech titans want to be near and want to have that proximity of power. They've seen how helpful that's been to the stock of, say, Tesla, with Elon Musk becoming this quote-unquote first buddy and now getting a White House email address. But also, a little bit more strategically, this is potentially a president that really wants to create national champions to make sure that the U.S. has the right companies in place, especially when he's trying to combat adversaries like those in China.
Anne-Marie, thank you. Let's keep that conversation going. Joining us here in Davos, Switzerland, David Rubenstein, the co-founder and co-chairman of the Carlyle Group. David, it's good to see you.
My pleasure to be here.
Thanks for joining us. We caught up with someone you know well, Mr. Friedman of Canyon Partners, someone who you've spoken to quite recently, and he said that the inauguration felt like a commercial for all the best of the United States of America, all the CEOs from the biggest tech firms. Joe Biden, the former president, has said something different. He said an oligarchy is taking shape. How do you see things?
Well, I don't want to side with either side and say either person is right.
You know both of them.
Right. I would say that clearly there are a lot of technology people that are involved with Donald Trump, and they were very visible at the inauguration. You could see the most visible people at the inauguration right behind the president when he was being sworn in were the tech CEOs. The finance CEOs, they must have been in Wall Street doing deals, or maybe they're in Davos. They weren't there. There's no doubt that business people have become very important in the American economy in the last couple of years because of technology. There's no doubt about it. This is true for President Biden, President Trump. The technology companies in the United States are not only dominant in the United States, they're dominant in the world. So if you live anywhere in the world today, can you get through get through the day without using American technology? Almost everybody in the world is using either Amazon or an Apple or Facebook or Google. And European technologies are not quite like that, and even the Asian technology, with the exception of TikTok, isn't really, prevalent. So the American technology leaders have become important business leaders, not only in the United States, but all over the world. And they're more than business leaders, they've become like folk heroes in some ways. People that started these companies, Bill Gates, Mark Zuckerberg, among others, and the late Steve Jobs. These are like people much larger than life figures. And I'm not surprised that President Trump would want to involve them. And I think President Biden did meet with them as well.
Mark Zuckerberg said recently in a podcast with Joe Rogan that he felt like the European regulators were going after the US tech firms, and the US administration was giving the Europeans cover to do that. Do you sense a shift where we are now celebrating our national champions under Donald Trump in a way that maybe we haven't done over the last 4 years?
Well, I think all presidents want to celebrate American technologies. I'm not sure exactly what Mark Zuckerberg is referring to, so I can't comment on that. But there's no doubt that when you have American technology companies that are very dominant, Google is another one that had a lot of problems in Europe, you expect Europeans to maybe regulate because they're not happy with the fact that American companies are dominating their technology. Europe and France really invented the internet. They had a kind of an internet before we had the internet, but they kind of lost it. And as a result, today, think of a European technology that you need to get through the day. There's virtually none of them. So I'm not surprised that Europe is upset about it, but Europe is an important ally for the United States, so I don't expect that.
Rolex, Cartier.
Well,
quite literally need them to get through the day.
If you want to have a great summer vacation, there is no place better in the world than the Mediterranean or Europe. And the museums are great, the food's great, the people are friendly, everything's wonderful. But if you really want to build a great technology company, many of the great technology leaders are moving to the United States from India or from Europe.
So there's a larger question here about how much we've priced in the U.S. market, tech market, divorcing from China at a time when it seems like maybe that's not exactly Donald Trump's plan. And I wonder whether that might be the surprise, actually a shift toward a more amenable approach toward China than currently this market is expecting.
I can't speak for Donald Trump, obviously, and he changes his mind when he feels it's appropriate to do so. He's a very transaction-oriented person. I wouldn't say he's as ideological as transaction-oriented. That would be my perception. And therefore, if he can get a deal with the Chinese on something that would be helpful to the United States, I think he'll do that. I've read that he wants to move there and get there relatively quickly and have a meeting with Xi Jinping. I think that'd be a good idea. But I think it's too early to say whether China is going to go down and the United States is going to go up in terms of their fight between each other, whether it's going to be large tariffs. I think the Secretary of Treasury said, designate, that the tariff policy is a maximalist policy, which is to say it's to be used in negotiating positions. So I suspect that will be what Donald Trump does, and his people negotiate and have the threat of tariffs, but maybe not impose them.
Well, the reason why I ask this is because we're trying to figure out signal from noise, right? And the TikTok ban that was delayed for 75 days, there's a signal in that maybe there isn't as much of a concern about the national security concerns surrounding a property like this, at least in Donald Trump's mind. And that could open the door to more negotiating between the U.S. and China in a way that a lot of businesses had really backtracked from. How much are you hearing them actually start to look at potential opportunities again with China, given that maybe that got overestimated?
On the national security information and concerns, I don't have access to what the senators and members of the House saw, so I can't comment on that. But I would say Donald Trump is obviously interested in national security, but he may have some way to deal with that if you have an American presence in the company or American ownership. So I just have to wait and see. It might take more than 90 days to actually get this resolved. Business deals don't get done that quickly. But the fact that TikTok is able to get the attention of the President of the United States in a way that many people wouldn't have expected a couple months ago, shows that this is a technology that obviously has a lot of popularity in the United States. I think about 170 million users, which is staggering when you think about it.
Right now, the takeaway for us from Davos has been this incredible optimism, this whole deal-making surge that we were expecting. Do you think that's overplayed, or do you think that that's going to be validated in the numbers?
Well, the optimism certainly is here. Whether it'll be merited, I don't know yet. But I do think that many business people feel that there'll be more of an opportunity to get regulatory burdens removed. There'll be more opportunity to get things done that won't have antitrust concerns. The SEC won't be as big a challenge for many people. I think that is the feeling of some business people, not everybody. And that is the feeling that I think is fueling a lot of the optimism, sure.
Is that your feeling?
I'm sorry?
Is that your feeling?
I feel it's a different environment. It will be different. I think there were some pluses to some of the things that were done in the previous administration, and there were some things that probably I wouldn't have agreed with. And we'll see what the new administration is going to do. I think an important thing you should think about is this. We've only had a president, the second term, non-consecutively once before. That was Grover Cleveland. And when you have second terms for presidents, sometimes in the second terms they get tired. They make mistakes. Reagan's second term wasn't perfect. Obviously, Nixon had to leave. Bill Clinton had some challenges as well. Maybe that's because in a second term, a president gets tired and his people get tired. Maybe if you have a president who has served as president before, actually knows something about the job, has some chance to think about it, comes back with fresh people, maybe a second term that's not consecutive might produce some good results. Well, time will tell.
We will see, and we'll catch up with you soon, no doubt, as well. David, appreciate your time.
Thank you.
Thanks for being with us. Thank you. David Rubenstein there of the Carlyle Group. Plenty of stories elsewhere, with equity futures here up by 0.4% on the S&P 500. With your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Shares of Goldman Sachs are falling in the pre-market trade this morning, down 1.2%. The bank preparing to promote a slate of star executives to run its equities, fixed income, and banking units. People familiar tell Bloomberg that the plans will spotlight the firm's next generation of leadership, giving them the reins of Goldman's biggest Wall Street businesses. The bank also plans to name new co-heads of its international unit, with Richard Nada stepping down to become vice chairman of Goldman Sachs. JP Morgan Chase is setting up its own so-called war room to analyze the impact of early Trump policy shifts. The bank's asset and wealth management CEO, Mary Erda, is telling a Davos panel that the war room is already in action after President Trump signed several executive orders on day one. Erdo saying that the Trump administration is positioning itself as, quote, very pro-business, and that the U.S. economy is in go mode to kick off 2025. Apple's iPhone sales in China plunged more than 18% during the December quarter, shares off in the pre-market trade. According to independent research, it relinquished the number one spot to Huawei Tech with an uneven debut of its AI upgrades. The drop in China also drove a global slump of 5% in the iPhone sales during the holiday period. Apple will report its full quarterly results on January 30th. And that's your brief. John.
Danny, thank you. That is the earnings report to watch at the end of this month. Just what is going on with Apple. Looking forward to the commentary from the company on what's not just happening with iPhone sales. I think that's the obvious place to go first. What's happening in China? This is Tim Cook, the diplomat, celebrated for Trump Volume 1 about how he navigated this tariff story. Lisa, how different are things going to be in Trump Volume 2 for that particular leader?
And it's not just the Trump versus Xi. It's also the AI advancement or not that's able to be sold in China, and the fact that you're seeing real declines in sales in that region.
Up next on the program, navigating uncertainty.
We obviously went through an inauguration, a change of power in the United States yesterday. I think we're going to ultimately have to see what the year brings, because there's still more unknowns than knowns in the equation at this point.
The opening about 42 minutes away. Equity futures, a decent tone so far this morning stateside. Equity futures positive on the S&P, on the Nasdaq, on a Russell. Russell had a great week last week, one of the best weeks of the year so far across the board. For the S&P 500, the best week going back to early November. A few reasons for that, Lisa. CPI, PPI, a dovish wallet, all of the above, going into a Trump administration where we're still trying to work out all of the above. What's going to happen with taxes? What will happen with trade? What will happen with immigration? Still far too early to take any real signal from what you've heard over the last 24 hours.
Can I just point out that CPI and PPI, the fact they came in disappointing, goes right to the bond market, and that any gain that you saw in the equity market probably had more to do with that than set policies, because as you've said, that volatility in policy proposals will be vast and frequent.
CPI and PPI feels like a lifetime ago.
Yes, it does.
Given what we have to confront in the weeks ahead and all the changes we're all expecting. Under surveillance this morning, navigating uncertainty.
I always take Davos with a grain of salt because, you have lots of different opinions here. And always the start of a new year, everyone likes to be excited. Everyone likes to be bowled up. We obviously went through a inauguration, a change of power in the United States yesterday. We know that's fairly positive for business. On the fundamental level, it's positive for business. I think we're going to ultimately have to see what the year brings because there's still more unknowns than knowns in the equation at this point.
I think it's fair to say that Gary Cohn thinks the boat might be loaded too far to the one side at the moment, going into 2025.
I think a lot of people are thinking that. Getting them to say it probably is a different story.
Let's continue the conversation. We can wrap up today's coverage with Antonio Neri, the HP Enterprise CEO. Antonio, it's good to see you, sir.
Good afternoon.
We've spent the last month or so talking about mergers and acquisitions. We've had bankers come on the programme say it's going to be easier. We're expecting a boom in 25 and beyond. They're all fired up. You've been living it for the last year or so with Juniper Networks. Can we start there? Approved by the UK and the EU regulator, why has it been so much more difficult to get it past the United States?
Well, we're still in the original process and timelines to communicate. And in fact, last year I missed Davos because I was doing the announcement of the deal. And we said that we expected the deal to close between end of calendar 2024 or early calendar 2025. We have had a very collaborative, very, I would say, productive process with the U.S. Antitrust Division. And we now expect, obviously, to the transition of the administration to re-engage in that conversation. But nothing gives me pause why would this deal will not get through, because A, is pro-competitive. It gives customer a much modern alternative solution for the networking aspect of what they do. And at the same time, it's good for national security in the context of the United States. It makes us much stronger when we compete outside the United States. So I'm very optimistic about it, but we have to go through the process.
So are you ready to start engaging or thinking about another deal, or is this basically tempered your appetite in the meantime?
No, I think, we have been executing a very curated strategy, Lisa. I think if you think about the progress that HP has had, believe it or not, almost 7 years as CEO, we innovate in the hybrid cloud, understand that the world is hybrid. We also taking advantage of this massive inflection called AI, which HP is the largest vendor when it comes down to supercomputing power. We actually power most of the supercomputers around the globe. In fact, the top 3 supercomputers are Hewlett Packard Enterprise Systems. And then at the same time, now we think about this opportunity with networking, because fundamentally, the core infrastructure to deliver hybrid and AI is the network.
You have some high-profile clients that might be worth more than others when it comes to publicity and drawing enough attention. Elon Musk actually just entered into a contract, his X platform entered into a contract with HPE for AI accelerating servers. And I'm just wondering, is that an extra vote of confidence based on his position within this administration?
So first of all, we have not talked about what customers, and we don't because of confidentiality. But I will say that a lot of the customers come to us because of that unique heritage and expertise we have building large systems at scale. And the reason why it's important, because it's not just the power and the performance, how we work with NVIDIA and others, it's also the ability to do it in a sustainable way. And when I think about these deployments, you need to think about the energy consumption, the circular economy, and then ultimately how you run these systems. And that's why in October, we announced the first ever industry first of direct liquid cooling technology, which is different than what people talk about liquid cooling, which is more this GPU. We actually cool the entire system with liquid, including the networking switch. And if you look at the El Capitan system, which is a testament of the United States working with us, is the fastest and largest supercomputer, which is 100% liquid cooled. When you walk in that data center, it's so quiet. There is no fans, no noise, nothing.
So you think we can reduce the associated energy costs with this as time goes by?
Well, we have shown that when you go from air-cooled to liquid-cooled, we can reduce the energy consumption by 90%. Think about that. Obviously, improve the performance dramatically. But at the same time, we reduce the space by 50%. Why is that? It's because the entire system is well utilized. There is no need to leave holes and spaces to air cool. Now, when you think about it, when you burn a finger, where do you go? You don't blow it. You just put it under the water. And that's a much more efficient way to cool injuries or systems.
Before we let you go, one theme of Davos so far has been this incredible optimism, companies ready to deploy cash. And I just wonder, AI adoption has taken on a much more realistic tone. How ready are companies to deploy real, meaningful cash? And I'm talking about away from just some of the big tech players.
Yeah, and that's why, Lisa, it's important we look at AI in three unique segments, right? We talk about model builders, hyperscalers, service providers, obviously a lot of CapEx deployment to build large infrastructure at scale, and there is nothing stopping there. Then you have the sovereign piece, which obviously here in a place like this is a topic of conversation because you cannot be left behind in adopting AI, but there are different challenges there. The inclusion of culture and values into this large language model because ultimately you can't lose the fabric of the country through these transitions. And then you have the enterprise. And there we have gone from what I call exploration to implementation. If you look at my company, we have already 250 use cases that we have either ideated or deployed. And now is ramping faster. But there is all about the simplicity of the deployment and the use, not the actual GPU. It's the whole ecosystem delivering a solution that's easy to deploy. In fact, we deploy a system in 3 clicks and 30 seconds. That's how simple it has to be to accelerate the deployment. You need to be in the loop, on the loop, not in the loop. That's the message.
Antonio, final question before you go. Who's the heir to Messi? Who takes over? That's the most important question. Who's the heir to Messi?
It will be hard to find one, but I do believe, and we are a big partner of FC Barcelona, that Yamin Lamal is going to be one of the
quite a talent,
stars. Yes,
quite a talent. Antonio, it's good to see you. Thank you, sir. Appreciate it. Antonio Neri there, the HP Enterprise CEO. As we count you down to the opening bell, I just want to give you a feel for the calendar through the next several days or so. After the closing bell, we'll get earnings from United Airlines and Netflix. On Wednesday, more results from Travelers Insurance and Johnson & Johnson. On Thursday, President Donald Trump speaking remotely to Davos. Plus, we'll get another round of jobless claims. On Friday, a BOJ rate decision and new Mitch sentiment as well. Coming up tomorrow, the guest lineup looks like this. From JP Morgan, Dan Pinto. From the New York Stock Exchange, President Lynn Martin, the Gap CEO, Richard Dixon, and the NASDAQ Chair and CEO, Adina Friedman. And later, if you can tune in, Lisa and I will catch up with Brian Moynihan of Bank of America in just a few hours' time. From Davos, Switzerland, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.